the trade deal between India and US, and as elaborated by the Honorable Minister, Mr. Piyush Goyal, I think it is going to be a major turnaround. And let us understand one thing, Varsha, that this trade deal is going to play out over a period of time. It is not going to be that it's going to miracle 24 hours or 3 months or 6 months. It is going to take a time. So we remain positive on specialty agrochemicals. Names that you mentioned, one of the names that we are positive is SRF. Other than that, we are positive on Pidilite, UPL, Vinati Organics, Tata Chemicals. And my sense is that specialty and agrochemicals can stand to have an extra advantage of benefit when it comes to reaching out to the world in terms of exports.
Got that. Well, thank you so much, Gaurang, for joining this conversation. It was pleasure speaking to you. Thank you so much.
Thank you.
Well, this was all the time that we have on this edition of Small Cap Buzzer. Stay tuned to NDTV Profit.
Ladies and gentlemen, at the NDTV Profit Conclave 2026,
this will be a $30 trillion economy in 2047.
At this moment, as Finance Minister, what's keeping you up at night?
The uncertainties from outside are still where they were. Can we see this deal through?
We are amongst the first to start negotiating. So our deal is very holistic, comprehensive.
The reason why we wanted to bring in this little increase was more for deterrent purposes rather than for revenue purposes. I propose to raise the STT on futures to 0.05% from the present 0.02%.
There's a buzz of a potential hike that could happen when it comes to options STT, and this could be major negative coming in.
Presenting the all-knowing, all-powerful Tech Guru.
Whoa. Guru? I'm no guru.
Okay.
I'm just a guy who loves his tech.
A show where the mysteries of megabytes and motherboards shall be unraveled.
Bro, nobody talks like that anymore. This is all about connected ecosystems, EVs and AI that you can use in your daily life. That's what we do on Tech 360. Real talk, real reviews, tech that you can actually use.
Tech has changed. So should your tech show.
Alright team, our new order show is ready. Now we need a promo. Something cool, something sharp.
Well, I'm sure we'll be having outstanding reviews, solid suggestions,
Expert advice, the latest trends. It's a lot simpler. We'll help people make the right auto decision. It's got the cool stuff, geeky stuff, serious stuff, all of it, so that you can discover, decide and drive. I'm Siddharth Sharma and I am your Automate.
New year. New power panel. India market open. Now in its boldest lineup. This is where the trends get tested and stocks get conviction.
I'll recommend a buy call on a stock only when I'm fully convinced on the stock. With a table-thumping buy.
And when the street wants the levels, he brings the chart.
Charts speak the truth.
welcome. You're watching Ask Profit, the afternoon edition. My name is Puneet Zaveri. With me is Somit Sarkar. And over the next half an hour or so, we'll try and solve all your stock-related queries. If you missed us in the morning, we did 69 queries, so we are going again for that big mark. I'm not going to quote any number today, but let's see how many queries we're able to solve in this 20-30 minutes. Before we do that and a lot more, let's quickly look at how the markets are doing. Another day where we've seen positive momentum. We discussed that in the morning, continuing that momentum at 154 points. The heat map will show you stocks like State Bank of India that continue to be the stock of the day, the hero of the day, on the back of positive commentary that's come in terms of the management performance. We've seen Shriram Finance, Tata Steel also being the big gainers in terms of the Nifty 50. You also look at the advanced decline ratio that's been consistent today in the trading session in terms of the gains and benefited the index as well. So over in terms of the stocks, it's been consistently about 2,000 stocks, then built on in that momentum in terms of gains as well. Finally, the mid cap and the small cap as well. That's the other positive part reflected in terms of the performance that we're seeing right now in terms of the mid cap index up 1.4%. Small cap was up 2% at one point of time, and now it's built on those gains as well. So that's a key positive. But and the BSE 500 to wrap up this list, individual movers that's been positively impacting the trade today. Web of Global now up 15%. At the start of the trading session, it was up around 7 to 8% and has built on the gains. Kalyan Jewellers also up 13%, PCBL up 9%, and the others as well. Deepak Fertilizer, Lakshmi Organic. Largely the losers 2 to 3% on a clutch of stocks, but it's the day of the gainers and the one in the green today. Let me also welcome in, at this point of the show, Lancelot Dikuna, who is joining us today. We'll also be joined by Akshay Bhagwat as well. But Lancelot, good afternoon. Welcome to the show. Let me go across and take the first query then. This one's on KRN Heat Exchangers. Now, our viewer has actually bought it at 800 rupees per share. Let's pull up the stock. So today is up 8.2%, but below his buying price. He's asking, and Harsh is asking, what he should do with this counter. Lancelot, is it advisable to average down a little bit? What would you recommend?
So I think if you look at this KRN, they are manufacturing tube heat exchangers for heat, air ventilation, air conditioning and refrigeration industry. So, typically these are industrial products and not a very high margin business. And if you look at the stock, it is trading at almost 66 times its earnings. So given that it is a very expensive company, in order to justify this kind of multiple, the growth has to be significantly on the higher side. While profit growth has been good and sales growth has been good, looks very difficult to justify such a high valuation. So one should probably wait for a significant correction in terms of price before one can look at averaging onto this stock. Because as a business, the business has been doing well, but it can't really, if you're buying in at this multiple, you're taking a big risk because any decline in earnings would mean a serious re-rating on the downside.
The next query is coming in from Nilesh Mehta, and it's on Dixon Tech. He has around 40 shares, bought at a price of 14,200. He wants to know whether should he continue to hold this counter for the next 1 year. Lancelot, any view on Dixon Tech? I guess we will try and connect with Lancelot. But Akshay, anything on Dixon Tech on charts?
Good afternoon to all. Yes, so Dixon Tech, if you look at the price charts, it's been in a downtrend, and lately in the past 4-5 trading sessions, there has been more of a recovery rally. This is more on the technical parameters since it was oversold. And I think the best case scenario as of now, which works out, is till the levels of 13,000. So the thought is hold on to Dixon Tech since you're invested at a higher rate of 14,000 plus. But it makes a lot of sense that once 13,000 odd levels are reached, take an exit from the stock.
Got the view, Akshay. But the next query coming in on Lemon Tree now. And our viewer is Pranay is actually holding 633 shares at 159 rupees per share and asking for a 3-year view. Lancelot, coming back to you, we've seen a corporate action actually on this counter. How do you see that in this context, and should Pranay continue to hold?
Yes, I think, Lemon Tree has been one of the people who are in the mid-markets hotel segment, and hospitality has been a growing space, especially within that segment. It is, while generally it is a very capital intensive business, Lemon Tree has focused on increasing its number of rooms through asset light model by way of management contracts and licensing, and that should augur well for the stock. Plus, we've seen recently they're looking at merging part of their businesses and and setting right the capital structure of the company. So I think he can look at adding to his portfolio as well as holding on to this stock.
Next is a live caller query coming in from Hyderabad. Nageshwar, you can go ahead and ask your query. Nageshwar? Well, I'll just read out the query. He's holding around 10,000 shares of NMDC, bought at a price of 84.89, currently sitting on a loss. Lancelot, any view on NMDC? Should he continue to hold?
So if you look at NMDC's financials, the company has been engaged in exploration, production of minerals, iron ore, and various sponge iron benefits. They also have ventured into the wind generation at point in time. So given that background, the stock is not very expensive. It's trading at about 10 times earnings. The question is that profit growth has been very slow and return on equity has been relatively low. So you might not see a big upside initially, and if there's a serious correction, one can look at adding on to the stock and then maybe exiting at a higher level.
Got your view, Lancelot. But the next question is coming in from Satish, and he's asking if it's a good time to invest in Bank of Maharashtra, IDFC First, and Yes Bank in the short to medium term. He wants to invest 1 lakh rupee each in all of these three counters. Akshay, would you recommend that trade?
Yeah, so short term with a time horizon of around 3 months of holding, yes, for Bank of Maharashtra, which is currently trading at around 66, expecting a rough target projection till around 77 to 85 with a stop loss of 57. So Bank of Maharashtra is a thumbs up for your 3 months of trading horizon. IDFC First Bank is the second one which you asked for. And again, this two stock fits the bill on the technical charts, where with a 3-month time horizon, you can look forward for targets of around 95 to 100 with a stop loss of 77. So both these stocks fit in the bill from short-term investment perspective, and you can go ahead with them.
Next query is coming in from Prudhvi. Wants to know whether is it a good time to buy Tilaknagar Industries. Can invest close to 2 lakh rupees in this one counter. Lancelot, any view on Tilaknagar Industries, and would it be advisable to invest 2 lakh?
So, I mean, Tilak Industries, Tilaknagar is one of the companies engaged in the sale of Indian-made foreign liquor, and has been there with a reasonably good portfolio of brands across the various segments. But if you look at its stock multiple, it's trading at almost 41 times earnings, and with an EPS growth expected about 8 to 10%. So given that background, it is a little expensive. So whether one should take the risk reward ratio at this particular price point really does not justify, because you may see 1 or 2 quarters down, and that could result in a serious re-rating in the stock. So at this point of time, I would not advise you to put all the money into Tilaknagar Industries.
Got the view, Lancelot. The next question that's coming in is on a small counter, Shemcon Specialty Chemicals. And a viewer actually has bought it at 468. If you can pull up that counter, this is Bhavesh Barcha. He's asking, he's already down 60% on this particular counter. So he's asking if he should continue to hold or exit. Akshay, a small one, we don't discuss this too often, but any view that you can offer, Bhavesh, of what he could do. He's down 60% already on this counter. Shemcon Specialty is the one that I'm talking about.
Yeah. So I was just going through the chart, and I think this stock has been in a downtrend since long. And at this point, it is building for a case for a recovery rally. This is not going to be a V-shaped recovery, but at the levels of around 187 where it trades, there's a chance it may go up till around 220 at the best. So you have to give it around 4 to 5 months of time for these targets. You need to maintain a risk management stop loss below 160. And if the levels of 220 are seen in that time frame, look for an exit at those levels.
Right. The next query is coming in from, not mentioned the name actually, Gautam Muhuri. Yeah, Gautam Muhuri. The next query is coming in from Gautam Muhuri. He has around 2,500 shares of Thomas Cook, bought at a price of 184. The current price is 110. He's sitting on a big loss. He wants to know whether should he sell, hold or buy more to average out the price. Any view here, Lancelot, on Thomas Cook?
Yes, Sumit, if you look at this business, it has become very competitive with a whole lot of online, travel companies coming in and offering services. The margins have got reduced. And Thomas Cook is also trying to shift into an online service model, but it still maintains a much larger workforce as well, a larger footprint. So I would suggest that, there's so much of competition in this space. Buying in at a high level, a high price and a high volume can only lead to, either low returns over the longer term, unless it really, consolidation happens and they become one of the major players in the market. But that's a long way off. So one should look at exiting rather than holding on to it.
Got the view, Lancelot. The next question that's coming in is on Uniparts. And our viewer, actually, Prem Kumar from Chennai, is holding on to this counter at 504 rupees per share. And he currently holds roughly 50 shares. So it's very close to the current market price. He's asking what he should do with this particular counter, Akshay. It's seen a recovery, but what would you recommend for Uniparts?
I think you can hold on, but give this trade some more time, minimum 3 months plus of holding. There is a strong resistance around 520 to 530 zone. Might get resisted at that levels, but down the line, the way the price volumes signals are, I think the stock is setting up for an upside till 625 odd levels with a time horizon of 6 months odd holding. So be invested. Stop loss will be below 400 for possible targets till around 620 to 640.
The next query is coming in from K. John from Kerala. He's holding around 1100 shares of Red Tape, bought at a price of 120. He wants to know whether should he hold or exit this counter. Lancelot, any view on Red Tape?
So Red Tape is one of the fashion lifestyle brand companies. Now this is again, they are in the business of selling footwear, clothing for women, men, and children. So it is a very difficult business, and you have a lot of competition in the space. And if you look at the multiple, it's trading at 40 times multiple. So I would say that it's a very expensive share to acquire at this point in time, and there is not much upside given considering that you may see a downside correction. So one should probably stay away from this stock.
Got your view, Lancelot. The next question that's coming in is on Titagarh, and this one is from Lalita from Bangalore, and she is a regular viewer, asking on Titagarh bought 20 shares at 805 rupees per share. She's currently at a loss, asking what he should do currently. But what would you recommend, Akshay, with this particular counter?
I think the stock has been in the downtrend, and lately in the last 5-6 weeks, despite budget where there is some speculative positive action, there has been no positive price traction till yet. And in all probability, the level of 700 for the support which it has been holding for long seems likely to be broken. So I would suggest it's better to take an exit in Titagarh Rail.
The next caller that's coming in is from Himachal, and Paramjeet is now dialing in with us. Paramjeet, good afternoon. Welcome to Ask Profit. What's your query?
I am having 10,000 shares of SBFC.
SBFC Finance, okay.
At the rate of 95. Want to know long-term as well as short-term view.
Got Paramjeet. Lancelot, let me come to you on this one. SBFC, the results has been, on the weaker trend over the last couple of quarters. We also have its peer, iFinance, which has come for its IPO, but he's bought it at 95 rupees per share. What would you recommend him to do?
I think in the financing business, people with stronger balance sheets and ability to raise capital or raise money at lower cost, they will survive difficult times. And if you look at SBFC, this is mainly focusing on secured MSME lending and loan against gold. So being a smaller company, its ability to generate low cost financing is extremely difficult, and hence they will have to provide loans to people who are willing to borrow at much higher rates. And then you have the cycle where because of that lending, you end up with higher NPAs. So I would suggest it's better to exit for this. There are various good companies having a higher, larger size, and one can look at adding to those.
Next query is a caller query coming in from Bangalore. Geeta, you can go ahead and ask your query.
Is it I mean, this is for short term. So is it right time to enter into PTC for 1 month time frame? By the way, I'm already holding NTPC 300 shares. So I just want to buy PTC.
Right. Akshay, what would your view on PTC Industries? PTC
Yes,
India, I believe, sorry.
Yeah. PTC India, the momentum is catching up strong on the technical charts. Volumes are picking up in the recent rise from 150 to 187. And in all likelihood, it is heading for targets till 195 to 200, where a massive resistance stands. So from a short-term perspective, roughly 200 is the target projection with a 1 month holding.
Got your view, Akshay. But the next question that's coming in is on Newgen Software Technologies. And Akshay, this is again for you. Is it a good time to buy into this counter? Is what Chandrasekhar is asking.
So for Newgen Software, I think if you want to time this trades, it's better we avoid it. First of all, because it's in a weak downtrend, it's highly oversold. So there's a good chance there might be a slight pullback, but really these are dead cat bounce, which I foresee and not the apt level still to buy Newgen Software. So give it a miss.
The next query is coming in from Surya Prakash from Vishakhapatnam. He has around 100 shares of SBI, bought at a price of 850. He wants to know whether should he book profits or buy another 100 shares at present rate. Lancelot, any view here?
Well, I think if you've seen the results of State Bank of India, they have come out with very good results. And given that, amongst the public sector banks, they are the strongest in terms of technology and also reach. So most of their businesses and reach is into, rural and remote areas. Given that their funds are the access to low cost funds and also their, strong lending parameters, I think one can wait for a little bit of a pullback because the stock has just gone up on the basis of its results. There could be some minor correction, but definitely one should look at adding on to this stock for the long term.
Well, very interesting views coming from Lancelot. You couldn't look at adding into SBI despite the 7% run on this counter. The next caller coming in is Vijay Lakshmi. Vijay Lakshmi, good afternoon. Welcome to Ask Profit. What's your query?
Sir, my query is on Ashok Leyland, sir. I'm having 2,000 shares of Ashok Leyland at the rate of 202.
Okay.
I want to know the target in short term.
You want to know a target in short term. Is that right, Vijay Lakshmi?
Yes, sir.
Okay, got it. Akshay, on Ashok Leyland, it's been a stellar run in the last few months. What would you recommend to Vijay Lakshmi? She's bought at 202 rupees per share.
So absolutely been a stellar run, one-way move from 100 to 200, almost a doubler, no stopping the stock. And I think this is the next rally which can unfold where 220, 225 can be the possible target projections. So with these targets, continue to hold.
Well, viewers as well as Akshay and Lancelot, it's now time for the rapid fire in this edition of Ask Profit. Keep your answers on buy, sell and hold so that we can take as many queries as possible in the next 3 minutes. The first question is coming in on TVS supply chain. Bhaskar has actually bought her at 199. Should he continue to hold the Lancelot?
Hold.
Manish is holding 2,663 shares of JSW Cement, bought at a price of 115. He wants to know whether should he continue to hold this counter or exit, Lancelot?
He should hold.
Buyer Crop is the other one, Lancelot. Sunny from Karnataka has bought her at 4,488. What should he do with this counter?
I think you can continue to hold this stock as well.
Kamakshwara Rao is holding a few shares of Concord Biotech, currently sitting on a loss of 40%. Should he continue to hold this, Abhijit?
Exit.
Sri Lotus Developer is the other one. Akshay, I know it's a very recent listing, but Kavita from Australia has bought her at 149. What should she do?
I'm sorry, it's a recent listing, so I would not have a view on this.
Ashok has few shares of ITC Hotel. Should he hold, sell at a loss or buy more? Lancelot, any view here?
You should hold on to ITC Hotels. Maybe you can buy as well.
IDFC First is the other one, bought at 74 from Satyan. Lancelot, he's asking, he has other banking names in his portfolio, so should he continue to hold this one?
Yes, he can continue to hold this stock.
Ravi has bought few shares of CAMS at a price of 750. Should he exit or wait? Abhijit, your view?
800 is the target, continue to hold.
Next one, Akshay, is on Happiest Minds, and we've discussed this stock quite a bit, but our viewer has bought it at 600 rupees per share. what should we do?
Exit.
Sudeep from Mumbai wants to know the right price to buy Gokaldas Exports. Abhijit?
Gokaldas Export, the right price to buy would be somewhere around 750.
Infosys bought at roughly 1458. Should he continue to hold is what Smita is asking. Lancelot?
Maybe hold, yes.
Srinivas from Hosur is holding 100 shares of Transformers India, bought at a price of 250. Any short-term target here, Abhijit?
Short-term targets on the upside can be around 310.
The next question, Akshay, is coming to you on IRFC, and our viewers bought at 152. What should we do?
Better to exit.
Nirmala from Coimbatore bought Tata Tech shares at a price of 650. Is it the right time to accumulate more, Lancelot?
Yes, you can accumulate more.
Kalyan Jewellers bought at 420 rupees per share by Sanjay. Should he continue to hold, Lancelot, given that this could be a start of a rally?
Yes, he can continue to hold.
Vignesh from Tamil Nadu wants to know whether should he buy HDFC Bank and hold for long term at the current valuations, Lancelot?
If it's long term, yes, he can hold.
Samvardhana Motherson, Akshay, is it a good time to buy for the next 1 to 3 months?
Yes, you can buy.
Sirisha from Bangalore wants to buy Sirma SGS. Is it okay to buy at current levels for an investment horizon for 1 year, Lancelot?
Yes, one can look at buying it for a year's time.
Well, got that view, Akshay, as well as Lancelot. That's the end of the rapid fire as well as this edition of Fast Profit. So thank you so much to both of you for helping us solve the 34 queries in this edition of Fast Profit. But viewers, that's all the time we have on this edition. I think we've crossed 100 queries.
Yeah,
we've crossed 100 queries yet again in the morning and the afternoon session. So thanks so much, viewers, for sending in your queries. We'll see you tomorrow if we missed any, but stay tuned. India Market Close comes up next.
Ladies and gentlemen, at the NDTV Profit Conclave 2026,
this will be a $30 trillion economy in 2047.
At this moment, as Finance Minister, what's keeping you up at night?
The uncertainties from outside are still where they were.
Can we see this deal through?
We are amongst the first to start negotiating. So our deal is very holistic, comprehensive.
The reason why we wanted to bring in this little increase was more for deterrent purposes rather than for revenue purposes. I propose to raise the STT on futures to 0.05% from the present 0.02%.
There's a buzz of a potential hike that could happen when it comes to options STT, and this could be major negative coming in.
Presenting the all-knowing, all-powerful Tech Guru.
Whoa. Guru? I'm no guru.
Okay.
I'm just a guy who loves his tech.
A show where the mysteries of megabytes and motherboards shall be unraveled.
Bro, nobody talks like that anymore. This is all about connected ecosystems, EVs and AI that you can use in your daily life. That's what we do on Tech 360. Real talk, real reviews, tech that you can actually use.
Tech has changed. So should your tech show.
Alright team, our new order show is ready. Now we need a promo. Something cool, something sharp.
Well, I'm sure we'll be having outstanding reviews, solid suggestions.
Expert advice. The latest trends. It's a lot simpler. We'll help people make the right auto decisions. It's got the cool stuff, geeky stuff, serious stuff, all of it, so that you can discover, decide and drive. I'm Siddharth Sharma and I am your Automate.
New year. New power panel. India Market Open. Now in its boldest lineup. This is where the trends get tested and stocks get conviction.
I'll recommend a buy call on a stock only when I'm fully convinced on the stock. With a table thumping buy.
And when the street wants the levels, he brings the chart.
Charts speak the truth, and I deliver the levels with no frills.
Parag Thakkar and Kush Bohra are now part of the morning crew with Tamanna, Neeraj and Alex. Same show, sharper voices. Every morning on India Market Open, your favorite market show just got better. On NDTV Profit, for your profit.
Hi, I'm Tamanna Inamdar. Watch me on NDTV Profit, where I break down the day's biggest business stories. What happened, why it matters, and what it means for your money.
Hi, I'm Neeraj Shah. Watch me on NDTV Profit for the most incisive market intelligence and meaningful corporate conversation.
And I'm Alex Matthew. Markets, mutual funds, insurance, personal finance. I help you cut through the noise and make smarter financial choices. And here's where you can watch us.
He has been tracking markets for over a decade, spots the trends before they hit the screen.
Good afternoon and thanks so much for joining in. You're watching India Market Close. My name is Alex Matthew and this is
Sharad Dubey.
Good afternoon,
Good
Sharad.
afternoon.
It's an exciting time and an exciting start to trade in the trading week. And what a week it was last week, right? 6 trading days, but all sorts of volatility, right?
Friday was the rebound globally, and then you see what's happening in the Asian markets and now the Indian markets.
Let's have a look at what the market is doing this afternoon on Monday. Sharad, let's take a look. You go into that
it's
side.
a sea of green, huh,
It's a
Alex?
sea of green. But
Yeah.
you know what? 0.7% of gains for the Nifty 50. This doesn't tell the whole story because the real action, Sharad, is in the broader markets. Pull up those broader market gauges if you can. The mid-cap index was trading with gains of about 1.5%, and the small-cap index
2.5%.
2.5%. But before we get into that, and before we get into the factors, let's also pull up the Nifty 50 heat map, because you're going to see more green than red on the screen, and it is a pretty picture. Right on top there is the stock of the day. Sharad, why is that the stock of the day?
Of course, the numbers are very strong. Broking upgrades are happening, and rarely do you see an SBI being a 7% gain.
Yeah, absolutely. Shriram Finance not too far behind. Grasim doing well. Tata Steel reacting to numbers. Quite a few upgrades also coming through from brokerages. We'll get you a sense of that on the show. But quite a few big gainers in the top list. At the bottom of the screen, you have a few heavyweights. ICICI Bank is there. Infi is there. ITC is there. Max Health is there. But a few of these names not doing particularly well from the broader markets. Let's also, or rather from the Nifty 50, let's also pull up the sectoral heat map, because this will give you a perspective of how this looks, and it's a really pretty picture. Just a couple of sectors in the red. The Nifty IT also having a pretty volatile day of trade today.
Right.
Gains of 1% at one point and now just about flat. But what are the factors at play today, Sharad?
Alex, it's a very interesting factors to play. The Nifty, if we talk about it, the important levels are there. You know, the strong technical support coming in for 25,800 mark, and a strong growth coming from Tata Group stocks as well as SBI. Also looking at Nifty Bank, they're actually better technically placed than Nifty, and the major macro overhangs that's largely done for India as well. All sorts of announcements we saw in the last 1 week, everything is absorbed. The risk on sentiment that has increased, be it the global AI trade, which me and Alex are discussing, and broader indices, that's the best part of the day. They have shown a very strong outperformance. Also, the options data is suggesting a bullish sentiment developing, and interestingly, the European markets, they also have opened in green. There are certain key levels to watch out for. All-time high levels is 26,373. The resistance is 25,850 to 25,900. For Nifty and for Nifty Bank also important levels are there to watch out. All-time high levels is 61765. The range, the resistance is between 60,600 to almost 60,900.
Okay, all right. So those are the factors that you should watch out for and the levels that you should keep in the back of your mind. But let's talk about individual stocks. We already took you through a few of them. State Bank of India, arguably the stock of the day. There's Shipping Corporation of India doing particularly well on the back of results. Its Q3 EBITDA is up as much as 90% year on year. You have Godrej Property, where volumes are quite considerably higher. It is also trading with gains of about 6%. Jubilant Ingravia, the India-US trade deal is seen benefiting this company, close to 10% gains here. Keynes is doing well after its Q3 con call. Positive developments there. Wellspun Living, again a beneficiary of the trade deal, and we'll get you more in the way of those stocks and sectors that benefit. REC PFC, the board approval that came through for a merger into PFC. PFC, remember, is a majority owner of REC. Sona BLW, there's another beneficiary of the trade deal with the US. And Atul Auto, the Q3 PAT jumping as much as 105%, reacting very strongly. But Sharad, we've got Hemen Kapadia joining us to take us through the key details on the technical levels, as well as Lancelot Dicuna. Gentlemen, thanks so much for taking the time, and good afternoon to you. It's a pretty picture that we're seeing today and a breath of fresh air. So first, Hemen, to you, what do you like when you look at the screen today? Is it an indicator to you that we are going to see more upsides and potentially test the record high levels on the benchmark?
A very good afternoon to you, Alex. Thank you for having me on the show. So it's a pleasure. The VIX has come off from 16, obviously. Credit policy out of the picture, trade deal done sort of. So no major event risk coming on. The US Federal Reserve meeting is gone. So that one is a positive. Everything looks hunky-dory. We need to take out 25,900. I agree with you, Alex. We look set to finally take that move out of all-time highs. But, well, there has to be a but everywhere, Alex. There's a huge gap. Normally, gaps get covered up. Out of 10 times, 8 times, gaps get covered up. And this gap, as far as the Nifty is concerned, Alex, is between around 25,490 and 25,101. So this gap is going to be, I won't say a hurdle, but there's always that overhang that this gap is going to get covered sometime. One, it has provided support on Friday when we've taken support somewhere through the gap and bounced. Today we've seen another gap coming up. Now it's a Nifty, it's a benchmark index. Now gaps remaining open for too long, I'd be slightly cautious. So that seems to be the only fly in the ointment. Everything looks hunky-dory otherwise. But too many gaps makes me reticent to get too bullish without them getting covered. Alex.
And Hemen, what are the technical picks? I presume both will be a buy call?
Yes, Sharad. Both are buy calls, like you said, obviously. And firstly, I have a buy call on Grasim Industries. Okay, it's the beginning of the week. I have based this on the weekly charts. It's the beginning of the week. We have 5 more trading sessions left. No holidays this week. It's a 32-week breakout. I repeat, a 32-week breakout for Grasim. So it looks good. I believe this is the beginning of a bigger upside. So a buy on Grasim at 2920. Stop loss 2870. Target of 3020. It's a very modest target. I believe we should be heading significantly higher. The second stock, it's Hindustan Unilever. Something slightly similar in the sense a 22 trading session breakout is underway. I'm saying underway because it's a daily chart 22 trading session. We haven't ended the day today yet. About the 55-day exponential moving average, MACD, RSI, stochastic, mechanical indicators, crossover buy, positive divergence, base formation. Everything seems to suggest that HUL is also, it's sort of a mini move of what Grasim has done on the weekly. So buy on HUL at 2430, stop loss 2400, target 2490. Once again, conservative. I believe we have headroom for more.
HUL, one of the stocks that has made its way upwards from the low point of the day, now trading with gains of about 1/3%. But you know what? There's one stock that stands out today from the large cap pack, right, and that's State Bank of India. It's up 7%. And it's interesting because you have 8 constituents of the Nifty bank that are gaining. Right. State Bank of India right there on the top. the two private sector banks that are doing badly today, ICICI Bank, HDFC Bank.
It's still lifting the Nifty bank up.
Yes, exactly. But why?
See, the asset quality has been really strong. And remember, the management has upgraded a guidance also for the credit growth.
So why don't you tell them about it?
Okay, sure. So fair enough. And that's the stock of the day as well. Come, I'll show you what are the key reasons for it. And of course, there's an important management chat also, but that's later on. Just to put that in perspective, SBI's up move is very strong. So the PAT and the asset quality, they have beat the street estimates and by a significant margin. That's what the analysts have been talking about. Slight beat in net interest income. But most importantly, the asset quality, that has really done well. Provisions have come down sequential basis. And also the NIMs, that's at around 3%. That's in line with the street estimates, if I say. The strong growth coming in the RAM segment. RAM segment is your retail asset segment I'm talking about. Profits went up almost 25% on a year-on-year basis. And if you look at the other numbers, NI standing up at 9%. So the numbers are very strong. But the guidance upgrades, that's where the street was looking out for, and the management actually delivered. The credit growth rate has gone up, and you could say the loan growth, that's up from 12 to 14% to 13 to 15%. And these are the numbers which you would be actually talking about. The gross NPAs, look at that, a significant downtick sequential basis, and the same story goes for the net NPA as well. That is where the strength is lying in the stocks. Of course, the advances and the deposits, they were largely in line with what the industry were estimating. And of course, these are the numbers which you would be talking about. But most importantly, the NIM guidance, the management has said that it will be above the 3% mark. And CASA deposit has been largely in line with what the street has estimated. So enough of the operational numbers. The ROA numbers, they have also done well. Slippages ratio, they have improved by 5 basis points. But I had a chat with the management. And to give in more perspective to the chairperson, CS Sethi has spoken with us. Do listen in.
I believe that, the trade deals which have been announced are extremely positive for investment climate. Looking at that, we upped our guidance from 12 to 14%, what we have given earlier. For the current quarter, we have given the guidance of 13 to 15%.
Right.
We will definitely revisit this guidance in the next quarter for the full year. But for the current quarter, we are revising the guidance to 13 to 15%.
Okay, so 13 to 15%, this is something that the street is positive about, and the net interest margin guidance of staying above 3% is certainly positive as well. But Lancelot, I want to come to you on this one. The conversation that we were having earlier on in the day is the bank has a return on assets of about 1.2%. And there are banks in the space that have a better rating, but for the size that they have, this is quite positive. And for them to grow at 15% going forward as well on the loan book side is quite positive. But the question is that in the price right now? Would you invest at this point, or would you stay out?
I think if you look at it from a valuation perspective, even at this particular price point, SBI is trading at 1.7 times price to book. And if you consider that it will, with all the growth that we are seeing in the profitability as well as the asset growth, the net interest margin growth, this price still appears to be much lower than, let's say, many of the private sector banks. Also, if you look at SBI's technology platform, it is, its app and its platform it's on par with any of the private sector banks' platforms. So given that it has huge reach, as well as it's developed a technology platform that will be able to transform, digital banking, and most of its customers who are digitally savvy will use the app and for their business. I think there's still tremendous upside potential, and it's not really that expensive when one looks at it from a price to book perspective.
All right, so that's the perspective on State Bank of India. But a large part of what is panning out today has to do with the details of the trade deal trade agreement between US and India that have emerged. And that emerged first at the NDTV Profit conclave, where Piyush Goyal, the Commerce Minister, spoke about the individual categories and how they would affect the Indian, both the investor as well as the trader, and also, more importantly, the farmer. Because there was a lot of worry that some of the categories that were vulnerable would get affected, but he said that isn't the case. Listen in.
No concession, exempt from this trade deal. We have meat, we have poultry, all dairy products, GM food products, cereals like rice, wheat, sugar, soya meal, corn, that's maize, millets like jawar, bajra, ragi, kodu, amaranth, fruits like banana, strawberries, cherries, citrus fruits, pulses like green pea, Kabuli chana, moong, oil seeds, certain animal feed, groundnut, honey, malt and its extracts, non-alcoholic beverages, flour and meals, starch, essential oils, ethanol for fuel, tobacco. Bacha kya hai? Where is the fear?
No, see,
almost every farmer commodity which is made in India in good, respectable quantity, where we are not dependent on imports, has been kept out of this trade deal.
Well, Commerce Minister says, "Bacha kya hai?" Of course, we'll ask the brokerages also, unke paas kya bacha hai? The Nomura's view, they have given a welcome clarification on the entire fine print of the deal, and also they have stated that India has a strong ability to stick around those red lines and wait it out. Of course, a bullish thumbs up coming in from Nomura. Bernstein, they have stated that the US and India's treaty appears fairly constructive and a positive move ahead is expected. They are remaining neutral on India. An important target, 28,100. That's what you should be looking out for. Also, ICICI Securities, they have given a view on the agri and the dairy sectors that has been kept out of this agreement, and they have stated that the benefit will be coming in the auto as well as the generic pharma segment as well. Their Nifty 50 target for calendar year 26, that stands at roughly 29,000. That's the important level to watch out for. Also, looking at Avendus Spark, they have stated that they have become very competitive when it comes to the emerging markets for the exports to the US, and they are very constructive for calendar year 26 as well. So most of the broking houses, be it the domestic or the foreign, all of them have been bullish on this India trade deal. Lancelot, I have a question for you on this space. Which sectors will give a good risk-reward ratio on the long-term basis on this interim agreement coming to a close when it comes to India and US's trade deal?
So I think the areas that will get immediately benefited could be companies who are manufacturing like these tractors and trucks, etc. You have Bharat Forge, Mahindra, who have significant exposure to US markets, and they would be benefited in terms of the lower duties. So these would be the initial beneficiaries of the trade deal that would definitely make a big difference. The other area to look at is some of the pharmaceutical companies, and as well as the diamond segment, the diamond and jewelry segment, because they were also a major portion, major party to the exports that were happening. So these few sectors would be beneficial as far as the US Indo-US trade agreement is to be attached.
Why don't I take a quick view, Heyman, on a couple of these stocks? And actually, before we go into some of these stocks, let's talk about what's playing out at the bottom of the screen. Bajaj Electricals has just bounced off the low point of the day, but you see a sharp fall, and that's because the company has posted a loss compared with the profit in the comparable quarter. A revenue decline of as much as 18.5% as well, coming at 12.9 crore rupees. Or rather, that's the EBITDA dropping as much as 85% to 12.5 or thereabouts crore rupees, and the margins have dropped quite substantially as well. Heyman, on the charts, any view on Bajaj Electricals?
Actually, Alex, the loss came now, but the stock has been losing ground for the last 5 years. It's done nothing. Hatch tags gone down, lower top, lower bottom, peaked at 1400 plus in September 21. Since then, it's come nowhere close to that. Markets have gone on to do wonders until September 24. Even mid-caps, small caps were doing well. this stock has gone nowhere. So frankly speaking, this loss doesn't seem to be making much of a difference because it's been down in the dumps. Is it going to fall down more? I'm not sure. 385 is a level. If it closes below that, I believe further pain could be there, but it's oversold. And there was a huge volume spike a few days back, Alex, on 23rd Jan. Now that is more than 1.5 crores. And if that level holds, I'm assuming there would be decent delivery marking. That would imply that stronger hands are bought. So I don't think there's much to lose, but stock has done nothing for 4-5 years. So except an oversold situation and 385 not breaking, maybe there is something of a respite coming in, Alex.
All right, some respite for Bajaj Electricals, but the numbers don't seem particularly strong. But let's talk to Somit Sarkar about what he's picking up from the dealing rooms. We're winding down towards the end of the earnings season, and I wonder what Somit is hearing, either on the trade deal front, Somit, or earnings-wise. What's the buzz?
Well, with earnings coming to an end, block deals could pick up is what dealers are indicating firstly. And the first stock that I have on the list is potentially on that. GNA Axle is one counter. There's a buzz of a promoter stake sale that could come in anytime soon. The stock was up around 6% at one point of time, but has slid down from those levels. So keep an eye out for GNA Axles in trade. For Gravita India, there are buy flows on the PMS desk. Dealers indicate that the company will soon commission one of its new capacity, which is expected to be quite positive for the counter. For PNB Housing and for Premier Energies, there are buy flows on institutional desk. Both foreign and domestic institutions have been accumulating both these counters, and if you look at if you see the delivery volumes, that is also expected to be on the higher side. And lastly, when it comes to Lupin and BAC as a stock, now dealers are indicating their clients to buy Lupin and sell BAC, and this is purely on the back of Q3 numbers. They're expecting Lupin numbers to be quite strong, and for BAC, they're expecting a weak set of numbers to come in for the third quarter.
All right. Thanks a lot, Somit, for that. And these are the 4 stocks you will be looking at. But in the F&O space, what's buzzing in trade, that's also pretty much important. Largely, the technical setup is looking strong, and the options data is suggesting a positive momentum coming in. But the stocks where we are seeing a strong long build-up, of course, that includes Kalyan Jewellers and SBI. We spoke about these stocks, and strong up move coming in. It's holding itself. Short covering for Keynes Tech after this Q3 con call coming in. Crompton Greaves also, we are seeing a sustained volume-based buying coming from a DI. Long unwinding for NHPC and delivery. The volumes are not that convincing. But if you look at the short build-up, that's where REC is there. That's where the selling has kind of intensified. And Page Industries, interestingly, profit booking is coming after the company came out with its good set of earnings as well. Amongst this list, of course, we will be focusing especially on the short covering candidate, Keynes Tech. I just want a quick view, Hemant, for that. Keynes Tech, what's your view on that?
Positive divergence, rounding bottom, oscillators by bounce, some more upside, very much.
All right. Okay. Let's focus back to the earnings, and Man Industries, that's in focus. They have also come out with their numbers, and the net profit, there's a good jump for almost, you could say, 61%. And on the other hand, revenue also saw a 13% jump. Margins, interestingly, that's where, Alex, we saw a significant jump from 10.8% to almost 15.4%. And to give us more details about the earnings and the outlook ahead, joining us is Nikhil Mansukhani. He's the Managing Director at Man Industries. Good afternoon to you, Nikhil. A very strong set of numbers coming in. And what led to this strong growth in Q3?
Hi, good afternoon. So the growth is also, we've been, since the last year or two, we've been working towards improving the EBITDA numbers from 10 to 11 to 12%. Our guidance of the year was 11 to 12%, but with the orders in hand, plus the value-added orders in which we have the pipes, the coating, the value-added bends, we are able to, get a much higher margin. And we are hoping to maintain this for the coming quarters as well.
Nikhil, hi, Alex here. So I'm just wondering whether the tailwinds that seem to have played out in the third quarter will continue, or whether there will be some pressure on the input sides, because we've seen the way that commodity prices have moved. So what is the impact that you're likely to see there?
No, nothing as such really will come impact on the Q4 and Q1 of FY27. All the execution which has already been going on is the steel's been already booked. And in fact, the shipments are now going out. So we don't see any as such impact per se. Yes, from Q2 onwards or Q1 end and Q2 onwards, the impact of the commodity is moving up. But end of the day, like we said, it's a pass on. We book the steel, we convert and we sell it. So maybe slight bit of impact, but nothing substantial.
The margins have significantly gone up. You know, this is like almost calculated basis. It's coming 15% if I'm not wrong. And you just mentioned that, you know, there might be some pass-throughs coming in the first quarter or the second quarter. Do we expect these margins to sustain, say, for the Q1, Q2, FY27, or will there be some moderation?
So the realistic numbers are between 11 to 13%. Like we said, we at the management level are always working towards pushing the margin towards our long-term sustainable 14-15% growth. And I think between 13% to 15% would be a realistic number that we would be around. Which quite a bit of achievement for us where we were hanging around between 8, 9 and 10%. And we don't see a pressure on that between 13 to 15%.
Just a last sense, Nikhil, if you can, on the top line side and the outlook for business heading into the end of the financial year and the start of the new year, are you seeing triggers or pointers to a significant improvement? What are you seeing on the ground?
So see, for our outlook, what we committed this year was standalone 20-25% growth on the top line, and we will achieve that this year as well as committed. For next year, we are seeing a good tailwind with some of the production further coming online and good projects in hand. Order book is more than 4,000 crores already. And so we feel that we would be comfortably between 20 to 30% of our top line growth even for next year.
All right. Thank you very much, Nikhil, for giving your time and giving the outlook for Man Industries. And it's always a pleasure talking to you. But moving on to our rapid fire segment, we'll have the important stocks which we'll mention to you. And Hemen, we need to be fast, buy, sell, hold. That will be your call. So first one, transformers and rectifiers. The stock has been buzzing due to the volumes, but it's 37% already over a year. Your views on that?
Hold.
Hold. PCBL Chemicals, sharp gain in trade, up 10%. Even the volumes has picked up 3 times its 20-day average. Your views?
Buy.
Buy. Elcon Engineering, buzzing on the back of volumes. The momentum is there for the last 5 days and has gained over 16%.
Hold.
Okay, Carborundum Universal is the next one. Positive up move seen in trade today. Stock is up. Actually, it's dropping over a year, down as much as 21%, but the up move's over 6% in the last 5 months. Does that continue?
Buy for the next year.
Concord Biotech is the last counter. Profit booking is being seen after strong up moves. It is up as much as 11% in the last 5 days, down now as much as 4%. What's the view?
Hold at about 1450.
Interesting. So it's an interesting set of numbers.
But Alex, another interesting set is the unlisted space. I'm talking about NSE. And today BSE's number is also going to come. But NSE's number has been really strong, Alex.
Yeah, absolutely. And what is that margin picture, right? The margin performance was absolutely phenomenal. In fact, the top line growth of as much as 6.7%, EBITDA growth of over 100%. So it's a doubling that you've seen. And the margins coming in at 75.9, as a result of which the profit looking pretty strong at 15% or thereabouts. Now, key factors that you need to bear in mind with regard to the IPO, of course, you had strong earnings in the third quarter. And you've seen several headlines in the recent past. They've gotten that approval from the SEBI to proceed with their IPO. The board has already met, if I'm not mistaken, right. And there has been a conversation about how much is going to be sold in that offer for sale. The unlisted prices currently show robust demand. Very interestingly,
it's 2100 plus.
Very interestingly, Sharad, there have been people who have said that there is more action in the unlisted space for NSE shares than it is in the listed space for a few counters.
Correct. That's interesting to talk about. But yes, on Saturday there was 2 important things announced also in the board meet. Enhanced IPO governance. There's a new IPO committee being made, and They have also approved a wholly owned subsidiary to set up a coal exchange. Now that's an interesting announcement as well. A coal exchange comes in. So more competition?
More competition, and very interesting because from India's perspective in the power space, even though huge push is being made towards renewable, thermal is not going anywhere anytime soon.
Exactly.
If anything, there's going to be a need for a lot more coal going forward. On that note, gentlemen, Hemin as well as Lancelot, thanks so much for taking the time today, and pleasure speaking with you as always. Look forward to the next chat. We have to slip into a very quick break, but on the other side, we'll talk about your top trading bets as well as the top buy today, sell tomorrow picks and the sector of the day. We've got an interesting one lined up. It is the jewelry space. Stay tuned.
Ladies and gentlemen, at the NDTV Profit Conclave 2026,
this will be a $30 trillion economy in 2047.
At this moment, as Finance Minister, what's keeping you up at night?
The uncertainties from outside are still where they were.
Can we see this deal through?
We are amongst the first to start negotiating. So our deal is very holistic, comprehensive.
The reason why we wanted to bring in this little increase was more for deterrent purposes rather than for revenue purposes. I propose to raise the STT on futures to 0.05% from the present 0.02%.
There's a buzz of a potential hike that could happen when it comes to options STT, and this could be major negative coming in.
Presenting the all-knowing, all-powerful Tech Guru.
Whoa. Guru? I'm no guru.
Okay.
I'm just a guy who loves his tech.
A show where the mysteries of megabytes and motherboards shall be unraveled.
Bro, nobody talks like that anymore. This is all about connected ecosystems, EVs and AI that you can use in your daily life. That's what we do on Tech 360. Real talk, real reviews, tech that you can actually use.
Tech has changed. So should your tech show.
Alright team, our new order show is ready. Now we need a promo. Something cool, something sharp.
Well, I'm sure we'll be having outstanding reviews, solid suggestions,
Expert advice, the latest trends. It's a lot simpler. We'll help people make the right auto decisions. It's got the cool stuff, geeky stuff, serious stuff, all of it, so that you can discover, decide and drive. I'm Siddharth Sharma and I am your Automate.
New year. New power panel. India market open. Now in its boldest lineup. This is where the trends get tested and stocks get conviction.
I'll recommend a buy call on a stock only when I'm fully convinced on the stock. With a table thumping buy.
And when the street wants the levels, he brings the chart.
Charts speak the truth, and I deliver the levels with no frills.
Parag Thakkar and Kush Bohra are now part of the morning crew with Tamanna, Neeraj and Alex. Same show, sharper voices. Every morning on India Market Open, your favorite market show just got better.
Welcome back to India Market Close, and joining us is Nagaraj Shetty, technical analyst at HDFC Security, and Sudeep Bandyopadhyay, who's the group chairman at IndiTrade Capital. Good afternoon to you, gentlemen. Nagaraj, want to start with you. A very strong market, technically both Nifty, Nifty Bank doing well. What are your top picks?
Yeah, yes, rightly said. Market has been in a strong uptrend recently, especially after the formation of a significant gap on 3rd of February. And overall chart pattern is looking positive for the broader markets as well as for the market and for the Nifty as well. My two picks are, first one is for MMTC. MMTC has been in a consolidation phase over the last few sessions. Today made an attempt to break out of the short-term range. The overall chart pattern is looking positive. Currently trading around 6610, 6620 levels. One can look to buy at this point of time. Immediate target could be around 70. One can place a stop loss as 64. Second one is Eternal, Zomato. The Eternal has witnessed a sharp decline over the last few months and recently showed some promising bounce back from the lower levels, indicating important bottom reversal. Higher tops, higher bottoms has been formed in the daily chart and currently placed at the edge of breakout of the downtrend line resistance. Technically, overall chart pattern is looking positive, currently trading around 288.50. One can look to buy at this point of time. 308 is going to be the initial targets, and one can place a stop loss at 277.
All right, so those were the picks that Nagaraj had. Sudeep, I want to come to you quickly first on the IT pack, and then I want to get your view on jewelry. We've got a nice research piece that's lined up, so we'll present that to you and then we'll get your view. But on IT, at the index level, just last week, including Sunday, you had a drop of about, 5.5%, and quite a bit of uncertainty about the future, especially after that Anthropic update. Is this overdone in your opinion, or is it fair to say that you should be underweight right now on IT?
Well, I think I would err on the side of caution, and I would say that it's probably fair to remain underweight on IT, particularly general IT companies who provide services to multiple organizations in US and other parts of the Western world. The AI-related threat is real. Unfortunately, our large IT companies don't have their own AI models. They will have to depend on third-party AI models for providing services, which will increase their cost, and the customers will demand significant concession because of the simplification and reduction of manpower, which AI will bring. So revenue will be under pressure, margin will be under pressure. It will take some time for them to adjust and come back to the kind of margins they have been producing earlier. So I think we are seeing just the beginning of this AI-led disruption as far as these companies are concerned. If I have to look at IT, I've been maintaining this for quite some time. We need to look at niche IT companies, which are service providers to industries which are growing rapidly. And these Indian IT companies are a part of that growth. So travel and tourism, some companies are integrated into the travel and tourism, the ecosystem, like RateGain Technologies, Coforge. I think they have a good runway. Similarly, IT companies who are integrated into that automobile transition, which is happening from ICE to EV. Now, these companies will have significant growth linked to this transition. So Tata Technologies, Persistent Systems, these are the kind of companies we need to look at. KPIT Technologies, these are the companies we need to look at this stage, not the general IT service providers.
It's a product. That's a very interesting way of putting it, Sudeep. But jewelry stocks, they are firing up in trade after a good set of numbers coming in. And Alex, all that glitters is gold.
So I know that you like jewelry. I know that you've bought a lot for the Home Minister.
Right.
But then, come on, this is a little excessive, yaar. So, Sharad?
It's massive. I don't know. We thought that there would be a correction, but then again it goes up.
You know what they say about prices, right? The impact on supply and demand.
Right.
When prices go up beyond a certain point, had se zyada, demand actually rises. That seems to have panned out. In fact, let's go across to Jasmeet, who's standing by, to tell you how this entire pack looks. It's not just Kalyan Jewelers, by the way. It is the rest of the pack as well. And you just saw the update from PN Gadgil, 100% improvement in PAT. Jasmeet, what are you picking up?
Well, right, Alex, thank you for that. If we go across and understand what exactly leading to the positive rally in terms of jewelry stocks, let's quickly understand the overall section and overall jewelry stocks and how they're buzzing in trade today. Something like Kalyan Jewellers is up about 15% today, while if you look at something like Thangamalai, it's up 9%. If you look at Titan, it's up 2%, while PG Gargil also is buzzing in trade today, up about 6.5%. If you look at this rally, well, this rally comes on the back of the positive and strong Q3 numbers of Kalyan Jewellers, and even the commentary remains strong by the management, which has led to a positive momentum across the jewelry section. Let's quickly understand the key takeaways and the key numbers of Kalyan Jewellers, which led to the overall rally in the jewelry stocks. If you look at the overall revenue, it has been a beat in the estimate 5%, while if you look at the EBITDA, has been beaten estimate 16%. Even profits is a strong up move by 10%. And in terms of key takeaways and what led to this rally in terms of top line, bottom line, is something like an overall same store sales growth was about 30%, booming the top line and the bottom line of the management. Company also sees to be debt free by end of FY27 going forward. If you look at the overall commentary by the management, it remains strong. They see a strong pickup coming in the month of January as well. The wedding season, the holiday season, as well as the overall post-season Diwali in the last Q3 and Q4 are picking up for the management going forward. Further, they also make a note that they expect the FY26 to end on a very strong financial note. If you look at the key valuation in terms of which stock is available at a good price and which stock is available at a slightly expensive compared to the other players in the industry, with something like Kalyan Jewellers is trading at 60x from the current PE ratio. The TBS is trading at 16.5.3x. In terms of the other key factors, the Titan is something which is trading at a slight expensive valuation compared to the other peers, something buzzing at roughly 90 odd times, and something like a Senco Gold is trading at 35x when you look at the overall PE compared to the players. So all in all, strong up moves coming in for something like in jewelry business. Is something to watch out for how does the FY27 begins for this industry going forward.
Thank you very much, Jasmeet, for that. But Sudeep, want to get you on this. Jewelry space stocks have run up, and as Alex has stated, value over volume. Sudeep, what will be your take on this jewelry space as a whole, and is there any risk reward left?
I think the sector is definitely growing, and they're growing rapidly. My word of caution for the investor is be a little careful with jewelers who operate in a very small geography and they don't have a pan-India presence. So let's say Thangamile, PN Gadgil, they've done good, they've done well, but the valuation, look at Thangamile's valuation, it's quoting at close to 90 times of their profit. So it's like very expensive. And they're in a particular geography, don't have the pan-India reach, not even multi-state reach. So one needs to be careful on these niche jewelry players quoting at a very, very high valuation. I would rather go for a Senco, which has now expanded into multiple geographies, quoting still at a reasonable value. I mean, I shouldn't say reasonable, but at a better valuation compared to some of the other smaller peers. Of course, Titan is an evergreen, and it's always a favorite pick from a long-term perspective, and I think still can be picked up if somebody has a long-term horizon. Look, the valuation may look rich today, but they have multiple growth levers, and some of the other levers have started also working. So some of the other businesses like watches, saris, spectacles, I think all these have started performing reasonably well, and at some stage they will start contributing, apart from jewelry, of course, which is the star of the entire portfolio which Titan carries.
Heard that hitch, Sudeep, when you said 35 multiple PE is relatively better when you're comparing it with something that's trading at 75 or maybe even 90 in the case of Titan. Fair point though. I do want to go to Nagraj. Nagraj, very quickly on these jewelry stocks, just purely the momentum that they seem to have picked up. Does that continue? Do you ride that? Or do you stay away if you haven't managed to get any of them?
I think for the short term, there are some more upside bounce is likely. If you look at Titan, Kalyan Jewellers, they have bounced back very well from after a downward correction. Especially Titan, I'm a little bit confident that the way it has bounced back from the lower levels and the strength it has shown over the last few months looks like more upside could be there for the Titan as well. From here onwards, I'm expecting around 4450, 4500 is going to be the hurdle for the Titan in the near term.
Nagaraj, we have now what we call the rapid fire round, and we'll take the buzzing stocks, 5 of them. I would encourage you to simply say buy, sell or hold. The first stock is Kim's, and it's reacting to earnings today. It is posted a strong Q3, up as much as 8.3% or thereabouts. 1,000 crore milestone on revenue has been crossed. What would you say on the trading front though?
Yes, you can.
Hold. You can hold or buy?
You can buy.
You can buy. BEML. Board approves of 1,500 crore investment for a rail facility. The trading volume is triple the 20-day average. What would you do with this one?
Buy.
Trumpton Greaves, a strong Q3 again. Revenues up as much as 8% year on year. EBITDA margins coming at 10.3%. Stock is up 7%. The biggest intraday gain since the 16th of May last year. What would you do?
Buy.
And Sada Energy, weak set of quarterly numbers coming in, PAT slipping almost 42% on a sequential basis. Your view on that?
Hold.
Hold. Okay, Tanla Platforms, the last stock, the company's AI native platform has launched, Wisely AI. And of course, important news flow is coming in on the product launch. The share has risen 4% as compared to its peers, and the volumes also 82% below its 20-day average. Your view on that, Nagaraj?
Hold.
All right, so that wraps up the second rapid fire round, and we've covered quite a bit of ground. But the FMCG stocks are in focus today. If anything, they're a relative underperformer in a broad-based rally. The point is, and they're actually off the low point of the day, the point is that FMCG giants are doubling down on digital-first brands. Almost every player is buying into niche premium categories and scaling them faster than ever. The question is, what is driving this rush and who is winning that D2C race? Mahima is joining in to break it down. Mahima?
So the competition is really rising in the FMCG space, and how are large FMCG staple companies trying to combat that? It is via D2C companies and acquiring D2C companies. Overall, if you take a look at how CRISIL kind of puts this into picture, they've said that in the last 5 years, all FMCG acquisitions have happened in the D2C space, and from this, around 60% has happened in the personal space and 40% in the foods and beverages space. And overall, as to how this has grown, D2C companies have locked nearly 40% CAGR between FY21 to FY24. Now, if you take a look at how all of these companies have made recent acquisitions, I'll start with Marico first because it's very fresh, right? Recently made an acquisition in Cosmic Wellness, 60% stake is what they bought at 226 crores at that 7.4 times price to sales. So not a very expensive acquisition that they made. Before that, they also acquired a 93% stake in Zia Maize for 226 crores at 2 times price to sales. So not very expensive in terms of where valuations stand, but this marks their presence into wellness, premiumization, and categories that are catering more towards the Gen Z audience. Now, before that, in 2020, June 2020, they had acquired Beardo, which has scaled 4 times since FY21. After that, in 2021, they went ahead and acquired Just Herbs in July 2021, which cost 100 crores in Q2. And they also acquired True Elements in May 2022, which has also been doing very well for them. And in 2023, they acquired something called Plix, and that overall counter has also been doing very well for Marico as a whole. If you take a look at both of these brands combined together, they've crossed 1,000 crore mark for Marico in Q2 as well. The next company is HUL, and HUL they've acquired skincare brand called Minimalist in Jan 25, and this is exceedingly done well. Management is very positive when it comes to this acquisition. They also acquired stake in Ozivia in December 2022. Both these brands are expected to cross 1,000 crore mark of sales this year is what the management is expecting. So very bullish when it comes to both of these acquisitions for HUL as well. ITC is the next one. It went ahead and acquired Yoga Bar in May 2023. This this brand Yoga Bar plus Mother Splash plus overall 24 Mantra brands, all of these are going to clock ARR of approximately 1,100 odd crores is what ITC believes. Going forward, Imami also acquired Man & Company in December 2017. This brand overall has been doing very well for the counter. Strong double-digit growth is expected in second half, and management has said that it is again open to inorganic options of growth going forward or acquisitions going forward. Godrej Consumer acquired Mostak recently, single SKUs, men's face wash brand, and management is very bullish when it comes to this category growth as well. Now, why are FMCG companies going ahead and preferring D2C brands? Well, a lot of reasons. The first one, of course, being this strengthens their overall traditional portfolio and makes their entry easy in the luxury as well as premium space. Niche and premium categories is what they are aiming at via this. Growth is much faster in these cases via online channels because they already have presence in the online spaces, providing edge through premiumizations. Of course, we talked about that, and acquisition is not defining, the kind of not denting or defining the financial statements of the FMCG companies because they're acquiring these at very attractive valuations. This is the overall view as to how FMCG companies are kind of acquiring these small D2C companies and winning through them.
All right. Thanks a lot for that, Mahima. Sudeep, I just want to get in ITC. Of course, the acquisition play is there, but the taxation issues which are there, which has impacted the stock, and the channel checks, or you could say Panwadi checks, which are coming in, is that the prices are going to increase of the packets, also of the cigarette packets. Sudeep, I wanted to get your views on ITC now. How does the company now look forward now going ahead? Because habits, they don't change so much. It's an inelastic demand kind of a case study. But how do you see ITC? Is there a value emerging here now?
Well, I'll be cautious. Look, ITC, while they have an FMCG business, but still about 75-80% of the EBITDA comes out of tobacco and cigarette and related products. And as we know, the tobacco taxation has significantly gone up. I think this kind of hike has come after 25-30 years. So the expectation, the industry expectation, is of a volume coming down across the industry, and ITC being the leader will also kind of be under pressure. Apart from this, one-time central government intervention in terms of hiking taxes and duties on tobacco and cigarette products, there has been intense competition in the market between ITC and GPI and plus PMI, which is Philip Morris. I think the Marlboro launch in India has created significant challenges and competition for ITC. So I think this space, there are a lot of things which are moving at this stage, and it's very difficult to predict how things are going to pan out over a period of time. It's better to wait and watch. FMCG, as far as ITC is concerned, still a small piece of the overall pie. So I won't, of course we will monitor, but I won't pay too much of attention on that. Tobacco is what is going to drive ITC and ITC's performance in the near future.
All right. And you did see at the end of last week, ITC as well as the other tobacco companies move up quite significantly. Godfrey Phillips, one of them, but it's trading under a tad bit of pressure today. Nagaraj, I want to come to you very quickly on the FMCG players overall, not just ITC. And we had this conversation about the business acquisitions that they have made. Any prospects for the space, and would you like any of the counters?
Yeah, a couple of stocks are looking positive right now. But if you discuss about the overall sector itself, FMCG has been in an underperforming phase over the last few months. We can see it has consolidated. Technical bounce is likely. I think it has moved up recently, and some more bounce is likely for the FMCG. I'm not saying it is a complete turnaround story, but some more bounces is likely. Especially Hindustan Unilever, it has been in a consolidation phase at the lower levels below the 200-day EMA. It has made an attempt to break above that hurdle. So some more bounces towards the hurdle of a next resistance of around 2500 is likely in the near term.
And Nagaraj, what will be your BTSC trade for today?
Yeah, BTSC, I'm continuing with the same calls I discussed a few minutes ago, MMTC and Eternal. MMTC is currently trading around 66.0510 at the same level. The technically overall chart pattern is looking positive. More upside is likely in the, at least for the short term, by next session, or at least for the next 2 to 3 sessions. Eternal has moved up a little bit. 289 is current trading, and I'm continuing with the target of around 308 level, and one can look to buy in these two counters.
Very interesting. All right. So sticking to the two trading ideas that you'd given us at 3 o'clock. But we spoke about ITC. ITC Hotels is something that you should keep in mind. Does it have a property in New Delhi?
Well, yes, they have, and even IHCL have a lot of properties in Delhi.
And those prices are going through the roof, aren't they?
The AI Summit, the rates are massive. It's astronomical. And Alex, just like to point that out, the hotel prices, they have skyrocketed. All the major hotels, if you look at the Delhi part, they have sold out till February the 20th. The hotels are seeing a sharp price increase as per Exigo report. It's a 6 times month-on-month jump in the hotel searches for New Delhi. Exigo's upcoming AI Summit which has come in, they are influencing the travel decisions as well. But look at the room rate, that's 70,000 to 1 lakh for an unsold inventory.
Wow.
My
this
God.
is like the World Cup that took place, isn't it?
Exactly.
It's similar kind of demand that you're seeing.
It's a major spike coming in, and I just want to get in Sudeep also on that. Very expensive room rates coming in, but the hotel pack, you have ITC hotels, you have IHCL. Your view on that?
Well, overall travel tourism is doing fabulously well, and I think it's expected to continue doing well. This spurt is because of specific, conference, AI conference, which is happening. And, after that, you will find a lot of excitement coming around T20 World Cup, then probably the IPL. So they have one after the other, events which will keep them busy and the rates high. So good time for the hotel industry, definitely. Occupancy rates are also high. So this is fantastic period. A lot of expansion is happening. The temple tourism has picked up in its real earnest, and the hotels there also are doing very well, temple circuit. So I think, we can look at buying into hotels even now. The prices are not cheap, but still, I would say EIH, considering the premium properties it offers, EIH can be looked at. Valuation is comparatively, I would say, still looking interesting. ITC Hotel, which the one you started discussing, is also good from a long-term perspective. Even for that matter, Indian hotels, yes, the valuation is not cheap, but if you're looking at from a long-term perspective, I think these are good stocks to buy and keep in your portfolio.
Sudeep, just to follow up on that, and if you're looking at the financials and the underlying of these hotel companies, there is a separate model that has emerged, right? Traditionally, it was looked at as a very capital-intensive business to set up some of these properties. But there are more companies that are open to the idea of having a franchise model. So when you study some of these companies and their operations, what do you look for?
Look, I think predominantly most of them are expanding through an asset-light model. It's a combination of own book as well as franchise model. But, maximum revenue, most of the hotel chains are getting through the asset-light model, which is the asset is owned by some other party. They run, they manage. Now, the management contract is of multiple nature, and there are multiple variants of how these contracts are structured. But basically, the fact remains that the hotel company doesn't own the property, the real estate. The real estate is owned by somebody else, and they manage at a profit share these properties. They lend their expertise, they lend their brand, and their booking mechanism works for these hotels, and they pretty much do everything. A share of the profit or a share or a fixed amount goes to the property owner. So I think it's a good model because most of the companies, if they had to own all the properties which they run today, that would have been a very, very heavy balance sheet with questions on return on asset, etc. So the asset-light model is in vogue, and I think it's doing pretty well for the hotel chains all over the world.
True, Sudeep. Travel, fooding, even hospitality, everything will be expensive at least for the next 1 to 1.5 months as well. Of course, maybe I might have to reschedule my traveling plans as well. But Nagaraj, I want to get you on Interglobe Aviation. Just that stock itself, there was a big correction coming in last 2 to 3 odd months. Some kind of up move again coming. Technically, how is Interglobe Aviation placed?
Yeah, looking placed at support. I think bounce back from the support around 4,600 levels. Currently showing some strength after a sharp decline from the 6,000. And looks like some more upside bounce is likely around up to 5200, which is the next set of hurdle, especially near the 200-day EMA.
All right, that's something to watch out for.
So I wonder, the fundamentals, right, for Interglobe Aviation. So some of the factors, of course, and Somit tracks this very, very closely.
Right.
There was last year this whole overhang of shares being sold in the market, and that was looked at as a little bit of a problem in terms of allowing the stock price to go up. And then
a big overhang.
The big overhang.
It was a 2,200 crore hit on the PAT.
Yes.
And we got a lot of vouchers also from the...
You did?
I did. My flights were cancelled. But yes, nevertheless, there was a big hit.
So the question, therefore, to Sudeep is whether or not you would buy in knowing that there are a few unresolved issues. Sudeep, what do you think about Interglobe Aviation?
No, unfortunately, I've not been a supporter of Interglobe in terms of buying the share. I do use services, but I've not been a votary of this at this stage. And you are absolutely right. There are a lot of unresolved issues there, both from that December event as well as the future. There are a lot of question marks, and airline industry at a valuation multiple of the kind which Interglobe is enjoying is a little difficult to justify. Somewhere something happens, and there will be a major challenge as far as the valuation is concerned. I think it's a good airline. They're running a tight ship. Performance is good. Everything is fine. The valuation is not right. So I would recommend buy at these levels.
A couple of stocks stand out. Actually, Sudeep, there is Shipping Corporation of India on one side, which is reacting to what was a pretty stellar set of numbers in the third quarter, but it is up 20%. So the question to you, is that warranted in your opinion? And the second is the pair of PFC REC, and after the budget now we know that the board approval has come through for that merger. Would you look at this company and say that it's a strong player in the renewable energy lending space? The book is it's growing pretty fast, and the merged entity will have that kind of capability. So between these two, do you have any comments?
Well, PFC REC definitely. I don't want to comment on Shipping Corporation. I think it's a little too ambitious, the valuation at this stage. Too much of excitement the stock post the results, so I'll avoid that. But as far as the power sector is concerned, overall power sector hasn't provided great returns during the last 1.5 years, but we have been very positive on power sector. We believe there's a structural upside for the next 5-10 years in the power sector. Look at the kind of capacity addition which all the leading players, whether it's NTPC, Adani Power, Tata Power, are talking about. And once these things do come on stream, or they are, they start putting money behind this, I think the commercial banks are not in a position to support these initiatives. The specific power financiers will have to step in, and PFC REC will have a huge role to play as far as financing these projects are concerned.
Right.
So we are very positive. The merger is a step in the right direction.
Thanks a lot, Nagaraj and Sudeep, for giving your time and giving us both fundamental and technical views at NDTV Profit. But moving on to the closing, a very strong Monday, and the levels have sustained both for Nifty and Nifty Bank. And interestingly, Nifty Bank's technical setup is better. Nifty up almost 170 points, but the number you should be watching out for is the advances and decline ratio. That is where you're seeing almost a 5:1 advances in the favor of bulls. Let's look at the Nifty indices, how they have performed. The constituents, and of course the stock of the day was SBI. Stock up nearly 7% and ending the day at the highest level. It's almost 8% up. Shriram Finance up 6%, and Reliance also holding up almost 0.8%. Tata Group of stocks doing the magic here. What's not working is, of course, ITC, NTPC, Power Grid and Max Health. That's where the sell-off was there, but largely a very strong day for the broader indices. Let's look at the sectors, how they have performed. And largely, we are expecting that most of the sectors are in green, except the PSC and the IT space, the consumer durables, PSU banking, small caps, one of the best performing sectors today, all are in the green. Apart from this market heat, let's just pull out the advanced decline ratio to give you the entire picture how things have panned out. And largely we see The advances are at 2026 for NSE and declines at 461. This is one of the most important charts you would be studying at the closing session today. Let's pull up the BSE 500 index to show you the stocks which would be in focus, and a strong set of numbers coming in most of the jewelry stocks. Kalyan Jewellers, Weber Global. Apart from that, also PCBL and Chemplast from the earnings point of view were also buzzing in trade. What was not doing well? Westlife Food, there's a little bit of profit booking happening. REC down on the news of the REC PFC merger. Apart from that, Max Health was the biggest loser in the Nifty index as well, and KNR Construction on the earnings. But net, it was a very strong day for the markets, and the technical levels were supported, and the global sentiment was also strong. Let's see what are the important factors to watch for tomorrow and our post-market hours. The US consumer inflation expectations, that comes in, that's what we'll be tracking. The global macro data. Pine Labs will be coming out from their anchor lock-in. That's what we'll be looking at. Apart from that, Unicommerce eSolutions, that's also an anchor lock-in which will be coming in. These stocks might be under pressure. Fundraising coming in for these stocks, Torrent Power and Safari Industries. And IPO listings and IPO openings are nil, but primary market is definitely there. Amber Enterprises, Apollo Microsystem and Aurobindo Pharma. These are the main earnings post-market hours. Also Bata India. There might be some selling pressure in this counter because people are expecting a weaker set of numbers. But tomorrow, we are having Apollo Hospitals, Britannia Industries, Eicher Motors and Escorts. 4 mainline Nifty earnings. And also, you should be focusing on Titan and United Breweries as well. These are the consumption names which we would be tracking this counter. But all in all, a very strong day. And that's all, folks, for India Market Close. Stay tuned to NDTV Profit. Up next is Market Express.
Ladies and gentlemen, at the NDTV Profit Conclave 2026,
this will be a $30 trillion economy in 2047.
At this moment, as Finance Minister, what's keeping you up at night?
The uncertainties from outside are still where they were.
Can we see this deal through?
We are amongst the first to start negotiating. So our deal is very holistic, comprehensive.
The reason why we wanted to bring in this little increase was more for deterrent purposes rather than for revenue purposes. I propose to raise the STT on futures to 0.05% from the present 0.02%.
There's a buzz of a potential hike that could happen when it comes to options STT, and this could be major negative coming in.
Alright team, a new order.
There is rarely a time in financial news coverage that things move so fast that the whole perspective of your conversation changes. And I was just thinking about it. We had an extensive, detailed and exciting economic survey. Then we had a promise-filled budget with some really new, innovative ideas. Then you had a monetary policy which added dimension. And here comes the India-US trade deal announcement to framework in 4 days flat. I wonder, we journalists are gasping for breath. As the chief economic advisor, how busy are your days right now? Let me start with that question.
If you guys have been sort of gasping for breath, you can imagine how it is inside. Over the last 6 to 8 months, as the PM has been saying, the Reform Express has been underway. So apart from these 4 things which you mentioned, and also you missed out the Indo-US free trade agreement that happened.
The EU. The EU-Indo free trade agreement.
So that also happened in the last 2-3 weeks. And then, in general, I suppose, along with the overall geopolitical developments in other areas as well. So it's been quite an intense 1 year, I must say. And but we are happy that both these 2 trade agreements do set up the economy nicely for 26-27.
I think it's the reform bullet train, not just the reform express right now.
That's well put. Yeah.
Let me come to brass tacks though. Let's start talking about the GDP number. We have a range in the economic survey, 6.8 to 7.2%. This was, like I said, this is a week which seems has 3 months or 6 months of news flow in it. From then, taking into consideration the India-EU FTA, the India-US interim agreement ahead of the bilateral trade agreement that comes in, is there a good case to revise this upwards? A lot of headwinds which would have been baked into that range have now receded, and visibly.
No, I agree with you. So that's why I said in the couple of days since the US-India agreement came into the picture, I did say that there is an upside risk to my range of 6.8 to 7.2, or let's say the midpoint is 7. Now I can think of an upside that could last anywhere between 20 to 40 basis points. But the reason why I would still wait until we see at least the first quarter of data for the new financial year. First, we have to wait for how the GDP numbers, new revised series, and the new base year play out. And secondly, simultaneously, if you read the economic survey preface, we talk about the 3 global risk scenarios, and they're also beginning to play out simultaneously. The way the volatility in financial markets has been rising in multiple asset classes, etc. Those spillover effects are still probably underway, etc. So there are, while India-specific developments have been positive unambiguously, we need to also factor in these global risk factors. And if we do that, then I think we need to take a calibrated look at how far I can increase my growth projections, or am I comfortable with the range that I have already indicated, is something that we are still working our way through that.
No, fair enough, but all things remaining the same. Between the economic survey in the last day of January and now, the volatility in commodity prices, say, remains the same. Other global risk factors remain the same. Maybe AI comes in as another risk factor, I don't know. But one major, very visible, glaring problem seems to have receded. Is it fair to say that 7.4% is not an out of the park kind of an upper end now that we can look at?
Before I answer your question, I must say I'm very impressed with the way you said everything else remaining the same. I thought only we economists keep using ceteris paribus, etc. This is the first time I'm hearing a journalist using those expressions. Ceteris paribus, of course, you said other things remaining the same. So I'm quite...
so we're listening and learning.
So, look, again, but unfortunately, we know that other things are not remaining the same, right? Gold went from 4,000 to 5,300 and came back to 4,600, now again back to 5,000. And what we are seeing in copper, etc., or for that matter, our own bond yields now close to 6.75, 10-year bond yields. All these factors are also happening simultaneously. Yes, I have to put on the positive side of the ledger. the US-India free trade agreement, which wasn't expected in general, and our own projections of 6.8 to 7.2 did assume that status quo would continue and not an announcement would happen. And therefore, on that score, you're absolutely right. But I also need to understand that, as I said, other things are playing out as well. But on balance, I would still say that now I'm prepared to concede that there is an upside risk to my growth estimate rather than a downside risk. So it's skewed towards the right side rather than the left side of the tail.
Mr. Nageshwaran, on the trade deal itself, we have seen, the initial agreement talking about, stopping oil from Russia. That's one of the conditions. Just wanted to understand that whether it will have an impact overall, not just diplomatically, but also financially. Are you reading that India may face potential loss as a result?
Look, I think these are relatively sensitive, and I don't think there is much to be gained by speculating on these things in public. Okay? At the same time, I can say that oil prices will be subject to, again, using Tamanna's phrasing, other things being equal, if the Iran situation doesn't get out of control in the Middle East and oil prices remain the same. So from an oil procurement perspective, it may not necessarily mean a big deal of difference to India. And also Russia is aware of the fact that after the Rosneft and Lukoil sanctions were announced, there was a natural tendency for India to remain cautious because we didn't want to expose our financial system to sanctions as well. So they also understand the compulsions, just as many other countries also take measures to safeguard their domestic industry in the face of sanctions. I mean, so when Nayara Energy got shut out, when Microsoft Office, removed their email client server facilities, even Zoho couldn't offer them an alternative because they were serving European customers as well. So they didn't want to get caught in that sanctions web. So there are compulsions and countries understand that. So I don't think this will be a major problem area for us.
Just also wanted to understand that India and US has trade surplus with 18% now we agreed upon. Do you see that thing continuing? We will remain trade surplus with 18%?
No, I don't think obviously you should look at India's duties alone in isolation. It has to be seen in the light of what are the duties that other countries face. And if you read the statement this morning, you would have also noticed that there is a line about that says India will continue to negotiate for lower duties from the 18% level. So 18% in isolation might appear as if it is higher than what it was 1.5 years ago or whatever, or 1 year ago. But obviously other countries also in the region, your competing countries face a similar or even slightly higher duty. So in that sense, I think it will continue to serve as well.
I just have a couple of follow-ups, and I'm going to rephrase Shrimi's question and ask it again because I think it's an important one. And I understand that we're waiting to hear official word on how much India reduces Russian oil, do we shut the tap, etc. My question is, can we afford to? Does the math work with Venezuelan oil coming in larger quantities? What if there is a situation where we have to reduce what we get in from Iran as well? How does the math work where we sit right now?
Obviously, if you speak of math, then math has to be worked out rather than being able to answer off the cuff. So these questions are not that easy to answer off the cuff. We need to work out the math before we can give you an answer.
It sounds like it would be a tough situation. So just let me put the first part of the equation in play. Can we afford to go to zero on Russian imports as of today? Or will it have to be pared down?
As I told Sharmi, I don't think it is useful for us to speculate on this in public, and I don't think that is the commitment we have. We haven't said anything of that sort. So I don't think we should be, looking at too much of hypotheticals at this point.
Okay. If I may ask you on the rupee, the currency has been in pain because of a lot of factors, including, I think, tariffs are part of it. Crude prices, I would say, a year ago to now, we're pretty much the same. Eased off, gone up, eased off. So that's not the big pain point. Do you see the rupee now strengthening? And maybe if we see a reversal of what has happened with foreign flows, or at least FPI flows, how do you think that figure or that situation now pairs out?
I personally think that the rupee will be one of the big beneficiaries of this trade agreement. with the United States. Because with respect to foreign investors, whether direct or portfolio investors, for them, this was a stumbling block because questions were raised about whether China +1 was becoming India +1, etc. And portfolio flows also, apart from other considerations, valuations, no AI story, etc. I think this damaged the sentiment quite significantly, and to the extent that this is removed, this barrier is removed, I do believe that the Indian rupee in 26-27 will be one of the beneficiaries of this trade agreement with the US.
Do we retrace a lot of the losses that we've seen? I think close to 50 basis. Do we retrace the losses in the last 1 year or so? Or
loss of what?
I mean the slide of the rupee, yeah.
Look, I mean, it's difficult to give you a precise number in terms of the forecast for the Indian rupee dollar exchange rate, but I do believe that we will definitely at least see the rupee not following a one-way path towards weaker levels. But again, as I said in the case of your earlier question about the growth rate, there are other things that are also happening simultaneously, and in the economic survey, we did point out that in general, if you take a last 5-year view or last since millennium kind of view, the Indian rupee has not been an outlier in terms of depreciating against the US dollar.
Ladies and gentlemen, at the NDTV Profit Conclave 2026,
this will be a $30 trillion economy in 2047.
At this moment, as Finance Minister, what's keeping you up at night?
The uncertainties from outside are still where they were.
Can we see this deal through?
We are amongst the first to start negotiating. So our deal is very holistic, comprehensive.
The reason why we wanted to bring in this little increase was more for deterrent purposes rather than for revenue purposes.
the days of our PSUs looking sickly and being sold at a song are behind us. Now they stand tall and proud with strong asset quality and loan growth for the banks and strategic focus for all of those that are commodity focused. But a question that many have asked, and Neeraj brought this up, why is the government not selling more of the proverbial family silver, particularly because the value has gone up to where it is right now? But some comments by Finance Minister Nirmala Sitharaman during the budget 2026 on strategic divestment opened up what could be a realm of possibilities, particularly in the real estate space, where so many of our PSUs are very rich and powerful. The unlocking of that could be the next big thing. But what is the word on divestment? Why not go straight to the source? So please join me in welcoming on stage Dr. Arunish Chawla, the Secretary of DIPAM.
I want to start off, sir, by asking you one question that has come in the minds of a lot of investors, is that if this target of 80,000 crores for FY27, stiff, considering what has happened in the recent years, how much of it is differentiated between equity disinvestment versus asset monetization? And does it bake into account some of the usual suspects like IDBI, or is it beyond that?
Since you talked about silver, let me first clarify, we neither sell family silver nor obsessions. We follow a composite value creation strategy, and that essentially rests on 4 pillars. Improve corporate performance for the CPSEs, list them, create market cap, make them subject to the market discipline, give fair dividends to all minority stakeholders, citizens, who have reposed their faith in us, and a calibrated disinvestment. You have to see the 4 together in a macro framework. That is important. Remember, We are not a department of disinvestment anymore. We are Deepam. We are a department for investments. We are a department for public asset management. And we light diyas or in the lives of ordinary investors, in the lives of minority stakeholders. That having been stated, let me back it up with evidence. The CPSEs, particularly the ones in the strategic sector, are doing extremely well. Their market cap has increased 5 times in the last 12 years. The dividends they are paying to their shareholders have increased 3.5 to 4 times during the same period. In the closing year, which is 25-26, our CPSEs achieved a record profit of 3 lakh crores, and they distributed a record dividend of 1.4 lakh crores, partly in the last year and partly in the previous year. And our market research shows that if you compare it to the Nifty 50, while the CPSEs just have a market cap of 10%, 10 to 15 if you put the financial institutions together, they distributed as much as 25% of the entire dividend on the market. It is not without reason that most mutual funds today have dedicated portfolios for the public sector, PSEs, and the National Stock Exchange and the Bombay Stock Exchange have specific indices dedicated to that. Over to you.
Completely agree. So just before Shamit, I still want an answer to my question, which is that of the stiff target or of the target. Let me not attach an adjective to it. The target that has been laid for FY27. You could be forgiven for saying that because PSUs are doing so well, let me not disinvest as much and let me do asset monetization in some fashion. What could the mix be when you want to reach this target?
Okay. You used and not used the adjective. I will use it. We are happy about the target. It is there because we want it to be there. And we have also innovated and moved on. The 80,000 crore target that you are talking about includes not just traditional disinvestment, not just traditional land sale. It includes all the new innovative forms of asset monetization. For example, in December this year, we got the regulatory approval for launching the first public InvIT. Now, let me explain to the viewers what is an InvIT. A public InvIT is the capital market equivalent of traditional risk capital, and it monetizes the present value of user fees and redeploys it to create infrastructure and public assets. If you watch the budget speech carefully, Honorable Finance Minister talked about a new innovation, which is REITs for monetizing and redeploying the surplus PSU land. This is also an exciting development because it will monetize the present value of rental revenues to redeploying unproductive or idle assets into productive use for everyone. It will enable this redevelopment without putting any burden on the budget or the parent CPSU which owns the land. So these are innovative, happy developments. We are trying to launch the first public InvIT in the country before the end of the current financial year. And we will take it forward, which is why 80,000 crore is good for us and good for the country.
Let me try, Neeraj, that once, because what we are looking at, the breakup, is it going to be 50-50%, 50% asset monetization, 50% from disinvestment? Are you trying to say that?
The reason we follow a composite strategy and the reason we don't break it up is that you can't work it out.
No, I do understand, because government move away from that separate target for disinvestment, and it's a part of capital miscellaneous receipts. I do understand, but sir, some estimation in mind, I'm sure.
No, that's correct. But why we avoid doing that is because we are a market-facing department and you are a market-facing channel. We all know the difference between ordinary media communication and market-sensitive communication. And, whenever we always keep 2-3 assets ready at one time, see the market conditions. We have an in-house DIPAM model. We have a market research unit which works on it on daily basis. Whenever we do it, we enter it with aplomb, we announce it, and we go ahead with it. Mm-hmm. It has been our experience when you give verticalized micro targets, your viewers and market participants work it out. They have a counter strategy. It creates a price overhang and does not give us the best value for the silver that you said.
Okay, let me, straight come to IDBI Bank. Deepam posted, last night that government has received bids from all potential bidders for the strategic disinvestment in the IDBI Bank. Wanted to know how many, bidders have applied so far, and when we could expect the announcement of the winning bidder.
We are careful about the privacy of strategic investors and the integrity of the transactions. The tweet which we put out is worded very carefully. We do not give either the number or the identity of bidders or any information which will help you figure it out. But I will not disappoint you.
But
I'll not disappoint you. We have reached the final stage, which is the evaluation and approval stage. You will hear more from us by end March, the end of the current financial year.
Okay. But I'm not asking you to actually reveal name, and I understand the market sensitivity towards it. I'm just asking the number of bidders which you received.
Let us
2 players, 3 players?
Let us respect the integrity of the strategic transactions.
Ladies and gentlemen, at the NDTV Profit Conclave 2026,
this will be a $30 trillion economy in 2047.
At this moment, as Finance Minister, what's keeping you up at night?
The uncertainties from outside are still where they were.
Can we see this deal through?
We are amongst the first to start negotiating. So our deal is very holistic, comprehensive.
The reason why we wanted to bring in this little increase was more for deterrent purposes rather than for revenue purposes. I propose to raise the STT on futures to 0.05% from the present 0.02%.
There's a buzz of a potential hike that could happen when it comes to options STT, and this could be major negative coming in.
Presenting the all-knowing, all-powerful Tech Guru.
Whoa. Guru? I'm no guru.
Okay.
I'm just a guy who loves his tech.
A show where the mysteries of megabytes and motherboards shall be unraveled.
Bro, nobody talks like that anymore. This is all about connected ecosystems, EVs and AI that you can use in your daily life. That's what we do on Tech 360.
Nifty ends in green today, closes above 25,850 levels. Broader markets outperformed the benchmarks. Two major IPOs, India's first pure-play AI Fractal Analytics and iFinance open for subscription today. Fractal Analytics price band for over 2,834 crore IPO set between 857 to 900 rupees per share. The price band for NBFC iFinance is set between 122 to 129 rupees per share. Domestic institutional investors have overtaken FIIs in Nifty 50 ownership for the first time, with DIIs now holding 24.8% against the FII's 24.3%, marking a big shift in market power. In a mega interview at NDTV Profit conclave just after the framework announcement of India-US trade deal, Finance Minister Nirmala Sitharaman indicated at other reasons on why FII's flows are constructed into India. She also highlighted that the sell-off was a part of the cycle and that it is set to reverse now. According to CBDT sources, new income tax rules and new tax forms to be notified by the first week of March. New income tax rules overhaul employee perks after decades, higher thresholds for tax-free meals, gifts, education and company car. Mega statement from the NDTV Profit conclave. India's chief economic advisor V. Anand Nageswaran indicated that the country's GDP growth for the ongoing financial year could end 0.2 to 0.4% points higher than earlier projected. Now, he added that this hike is driven by recent positive policy developments and also easing domestic headwinds. Good news for luxury car buyers. High-end American cars and bikes are set to get cheaper after India-US bilateral trade agreement to boost the market for American companies and India to cut duty on American CBU cars to 30%. Hotel prices skyrocket ahead of AI Summit in New Delhi. All major hotels in Delhi sold out till February 20th. Japanese stocks surged to a record high as Prime Minister Sanai Taikaichi secures historic election victory, paving the way for her agenda of tax cuts. Prime Minister Narendra Modi congratulates Taikaichi and also hails India-Japan ties in enhancing global peace, stability and prosperity. Hello and welcome. This is Profit 360 and I'm Himakshi Bahugna. Along the next half an hour, we'll bring you the latest from the markets as well as national and international news. And first up, let's see how the markets have fared today. So, Indian equities had another upbeat session today with, benchmarks indices extending their gains for the second straight day. Positive global cues have kept the sentiment steady and also several heavyweight stocks have helped, drive the momentum through afternoon. But it wasn't just the headline indices. Broader market participation and also the sector has moved, they've also told that there's an interesting story today. So for the complete market roundup, including the standout performers, we have my colleague Varsha joining us for all the market action roundup.
Well, yes, Nifty closes above 25,850 mark, up 0.6% in trade today. Broader markets outperform benchmark. Nifty Midcap 150 up more than 1.5% in trade. Nifty Small Cap 250 is up more than 2.5% today. SBI and Shriram Finance gained the most when it comes to Nifty. SBI more than 7.5% today. Shriram Finance follows up over 6%. While Kalyan Jewellers and Godrej Properties gained the most in Nifty Midcap 150. Even the jewelry stocks were in focus on the back of good numbers, strong numbers from Kalyan and Gold GM. Well, Shipping Corporation and Tarrell gained the most when it comes to small cap 250. Shipping Corporation hit upper circuit up 20%, while Tarrell gains over 13% today. All sectors end in green. Nifty IT ends flat. Nifty Media gains the most today, up over 4%. Saregama and Sun TV gain the most when it comes to Nifty Media. Well, Nifty PSU Bank gains over 3%. Nifty Realty is up more than 2.5% today. Lastly, if I were to talk about Nifty Bank, Nifty Oil and Gas, Nifty FMCG up for the second day in a row.
Thank you so much, Varsha, for that market roundup. And viewers, the Indian primary market is buzzing with fresh offerings as two major IPOs from Fractal Analytics and also iFinance have opened for subscription today. So starting with Fractal Analytics, that is India's first pure play AI IPO. Now, the price band for the over 2,834 crore IPO is set between 857 to 900 rupees per share. Now, the issue comprises both fresh equity and also an offer for sale component and is also expected to list on the BSE and NSE around February 16. Now, talking about the 1,010 crore IPO from NBFC iFinance, the price band is set between 122 to 129 rupee per share. The mixed offer includes fresh equity of up to 710 crores and also an offer for sale worth up to 300 crores by existing shareholders. iFinance, which also focuses on lending to micro and small enterprises, it also aims to use the proceeds to strengthen its capital base and also support business expansion. Now, the issue is scheduled to list on the BSE and NSE on February 16. And earlier, we spoke to iFinance MD Sanjay Sharma in regards to the IPO opening. Let's listen into his remarks.
I believe that when you are coming out of the bottom of a credit cycle, probably is the best time to be in the market because we are starting a relationship with the public investor. And what better than to start at the bottom and then build the trust as you go. So one is that I believe that it is difficult to get into the IPO at this time, but if you can, then it's a great time. Yes, it comes at a cost of a lower valuation, and I believe our valuation is very attractively priced. It's the lowest that we have seen in the private equity rounds.
Yeah.
But I think our existing investors are solidly behind that price.
Viewers, in a mega interview at NDTV Profit Conclave, just after the framework announcement of India-US trade deal, Finance Minister Nirmala Sitharaman, while replying to a question on the FIIs, indicated at reasons other than policy on why the flows are constructed, into India. Answering to a question at NDTV Profit Conclave, Sitharaman also highlighted the weaponization of the fund flows as trade tactics. Let's listen into that crucial remark.
Over and above the AI which is globally required, we have the manpower which is absolutely at it, at a high end. We are trying to give that kind of an exposure to AI even for the young fellows who come out of the college or from higher secondary, each for their levels. So on AI, I'm not sure, probably excluding China, I'm not sure if there's any country which is gearing up its manpower to be adept at AI as we are doing. And I can say this with a sense of confidence because you hear it from people who are looking for talented people who can be at various stages of AI.
No, their concern about the public markets is the lack of an AI play in terms of because a lot of the funds have gone towards the big companies which are at this moment building the data centers or the chips.
It's money coming only for AI. Come on, Rahul.
A lot of the flows have been in that direction over the past.
Never mind. You can always score a point on that. But I think India has still a lot of macroeconomic factors based on which till 2 years ago fund would come. But after a certain tightening up on certain other considerations, inclusive of sanctions which are happening, where tools are getting weaponized if a country asserts its sovereignty.
I think that's a very important point the finance minister makes. And of course, sitting on the sidelines of a match and doing commentary is the easiest thing for you and me, but once you're in and that's what you pick up, that's very important. The fact that flows are not just flows.
I'll add to it. Countries like Canada, their pension funds, countries like Norway, their sovereign wealth funds and so many others have been in touch with me, and I am actually being invited to go there, and I shall be going sooner. Are they also not affected by the AI consideration? They shouldn't be calling us at all. So different reasons prevail for different funds, specifically in the last minute, to say, all right, I won't go to India or I will go to India.
Viewers, the NSE's board has finally given the green light for its long-awaited IPO, and it'll be an offer for sale, subject to, of course, to regulatory approvals and also how the markets behave when that window opens. My colleague Sharat is sharing the NSE's Q3 and key factors for the NSE IPO.
Strong Q3 numbers coming in from NSE. The revenue numbers also saw sequential uptick, but the biggest surprise was on the margins front. The net profit up 15%, coming in at almost 2,409 crore rupees for the December quarter. The key factors, of course, is a very strong earnings, a good buzz in the unlisted space, and the sentiment is strong after SEBI's approval or the NOC which has come in for NSE's IPO. The street is expecting the IPO to come in the next 7 to 9 months, and it's likely that it would be an OFS. But there are two important takeaways from the board meet at NSE. The first one is that they are strengthening their IPO governance by reconstituting a dedicated IPO committee, and the board has also approved incorporation of a wholly owned subsidiary for a coal exchange.
Thank you so much, Sharat, for that. And viewers, the government will notify the new income tax rules and also the new tax forms by early March, with the overhaul including Form 16 coming into effect from April 1 after stakeholder consultations. So the new tax rules and also the new forms are aligned with the new Income Tax Act 2025, aiming to simplify the compliance through a clearer, simpler language. But the rule book also gets tougher, especially on the crypto asset side. My colleague Shrimi is breaking down the new tax rule book and what's changing, what it means for your money, and also why it matters.
Well, to align with new Income Tax Act 2025, the government has, proposed new draft rule for income tax as well as new tax forms, and they have already put on website on 7th of February and asked for stakeholder comments in 2 weeks. Now, let me take you through the income tax rule first. So, among the key suggestions, the key proposal, the first being is with respect to crypto disclosure norms. That's very important because what they are doing right now is, given the growing instances of tax evasion, they have tightened it further for both exchanges and intermediaries, which are now supposed to follow the strict reporting norms here and due diligence. So that's number one, and they have to do it from next financial year, and that's clarity also coming from the CBDT sources. Other than that, the employee perquisite has been also rationalized. Now, this is also happening after decades, and in fact, this is important from the terms of that the threshold, the higher threshold has been given for your tax-free meals, your gift, education, as well as company car. So your employer has to recalibrate everything in terms of the new rules which is coming out and which will be expected to be notified from April 1st. So this is very also important, and you get the benefit both on old regime and new regime. So that's also clarity is very important. Then the PAN reporting threshold has also been revised. What they are saying that a motor vehicle PAN is going to be, you need to report your PAN only above 5 lakhs. Similarly, for property PAN threshold has been raised to 20 lakhs, and the SFT, the transaction which you're supposed to report as far as property is concerned has been increased to 45 lakhs. So that important clarity is also coming, and it's the part of the draft proposal. Other than that, the CBDC, which is an RBI-backed digital currency, has recognized as a valid electronic payment mode. Apart from this, as far as new tax forms are concerned, it's the CBDT sources clarified that they are expected to notify by first week of March, since it's coming to effect by first week of April. And then, of course, by doing this, they're expecting to broaden the tax base. What they're saying that there are 12 crore of people actually who file the tax return. Out of that, only 9 crore has filed the return. So the 12 crore actually has paid it, but only 9 crore has filed it. So remaining 3 crore people who are left, the department is going to nudge them through communication, through emails, etc., to file their return, and that's also very important. So in all, of course, with the new Income Tax Act coming into force, these rules and forms are very, very important from the employee perspective and for the taxpayer perspective as well.
Thank you so much, Shrimi, for getting us those crucial details there. And viewers, as India's financial landscape continues to evolve, global rating agency Moody's has weighed in with its latest assessment. Now, Moody's has reaffirmed a stable outlook for India's banking sector, backed by the country's strong economic momentum. Now, the ratings agency forecast India's GDP to grow at 6.4% in FY27 and says that any further rate cuts, by the RBI are likely to be modest. So, while Moody's notes some emerging stress in the MSME loan portfolios, it expects banks' net interest margins to improve gradually and also supported by stable lending rates. So importantly, Indian banks continue to maintain healthy reserve buffers strong enough to absorb the potential loan losses. And another mega statement from the NDTV Profit Conclave. India's Chief Economic Advisor V. Anand Nageswaran has indicated that the country's GDP growth for the ongoing financial year could end 0.2 to 0.4% higher than earlier projected. Let's listen in to that crucial commentary.
In the couple of days since the US-India agreement came into the picture, I did say that there is an upside risk to my range of 6.8 to 7.2, or let's say the midpoint is 7. Now I can think of an upside that could last anywhere between 20 to 40 basis points. But the reason why I would still wait until we see at least the first quarter of data for the new financial year. First, we have to wait for how the GDP numbers, new revised series, and the new base year play out. And secondly, simultaneously, if you read the economic survey preface, we talk about the 3 global risk scenarios, and they're also beginning to play out simultaneously. The way the volatility in financial markets has been rising in multiple asset classes, etc. Those spillover effects are still probably underway, etc. So there are, while India-specific developments have been positive unambiguously, we need to also factor in these global risk factors.
And according to Labour Ministry sources, Labour Ministry to push codes implementation ahead of the nationwide strike on February 12. And for more on this, I'm being joined by my colleague Rishabh Bhatnagar. Rishabh, it's a big development. So when will Labour codes come into effect?
Right. So what we are learning from Labour Ministry sources is that despite the big sort of nationwide strike that's planned on February 12th, they are going to push ahead with the full implementation of the Labour codes starting today, and they will take effect starting April 1st, which is the new financial year. Why this is because everything that has to be done with regards to the passage of this particular code is been already done. What's left is the final rules that are supposed to come out, and those the dotting the I's and crossing the T's is happening with regards to that. So you'll have very quickly the final rules being rolled out for these Labour codes as well. What we're hearing in the run-up to this is that the government commissioned a survey by the V.V. Giri Institute, and what they found out was that employers and employees were largely in favor of the implementation of these codes, roughly about a 75% sort of approval rating coming in about the 2 months that this Labour code has been already in implementation. So that's what we're picking up from the Labour Ministry.
Okay, thank you so much, Rishabh, for gathering us, those details. And moving on, viewers, as India and the United States move closer on trade cooperation, one sector that's set to feel an immediate impact is the premium automobile market. A new breakthrough, under the India-US bilateral trade agreement that could significantly reshape pricing for high-end American cars and also super bikes here at home. So to take us through what this duty overhaul really means, the models likely to get cheaper, and also how Indian automakers could be affected, let's go across to my colleague Danish Anand, who's tracking all the details there. Danish, over to you.
Well, that's correct. As per the interim BTA between India and the US, certain American cars and certain American bikes are all set to get cheaper, and the first impact we will see on the high-end motorcycles, and by that I mean two prominent brands, Harley Davidson and Indian Motorcycle. So as per the interim agreement that we have just seen getting signed last week, the government will reduce the duty on these bikes from 40% to 0%, and this will be applicable only on those bikes with the engine capacity between 800 to 1600 cc, and for the bikes above 1600 cc it will attract a 30% duty. But on the other hand, as far as cars are concerned, so in a good news for luxury car lovers, Ford, GM and Stellantis cars of these brands, they are all set to get cheaper, and the new duty that the government will apply on these cars will be 30%. Currently we are seeing that the import duty on these cars is 110%, but as far as the impact on the Indian auto industry is concerned, there's going to be hardly any impact, because the government provision is about 2500 cc engines as well as 3000 cc engines. And if we look at the models that Indian car makers sell, we don't sell any cars in these particular engine capacities, so the domestic industry will not face any impact. On the other hand, it is a great news for those people that import cars, and especially this for those people that prefer buying American cars of GM and Ford. And let me tell you that both Ford and GM have exited the Indian market almost 3 to 4 years back. So now if anyone wants to buy these cars, they'll have to directly get in touch with these companies, because they don't have any local company or a subsidiary which is over here present in India. So all in all, if we see, there's not going to be any major impact on the Indian auto industry, as if we look at the Indian engines, they are much lesser than 2000 cc, and for the bikes similarly there will be no major impact, but it is a good news for the buyers.
Absolutely. Danish, just stay with us. While the auto market is seeing its own wave of excitement there, the hospitality sector in the national capital is also witnessing a sudden surge of its own. So ahead of the upcoming AI summit in the New Delhi, hotel demands have spiked sharply, with early travel patterns already indicating an unusually busy stretch for the industry. So there are signs of steep price movements, rising searches and also limited availability well before the event begins. So Danish, what more do you have on it?
That with the India AI Impact Summit set to take place next week in New Delhi, this is having a major impact on the hotel prices. As per the data provided
so there is an audio issue there, Danish. We are not able to hear you properly at this moment. But just for our context, for our viewers, the prices of hotels have spiked sharply in the national capital ahead of the AI summit. And
check 1 2 3, audio clear.
And, major hotels have sold out till February 20th in Delhi. Ixigo has seen a massive 6 times jump in the month-on-month, prices of, and also the searches for hotels. And then the room rates have soared, with limited inventory is what we are getting to know. And also the per night room rates between 70,000 to 1 lakh for the unsold inventory. And with that, my colleague Danish is also back, I hope, with a better line this time. Danish, yes, please tell us more about it.
Well, as per data provided by Ixigo, the hotel search, especially in central Delhi, has risen 6x, and it is all because of the Impact AI Summit, which the government is all set to, kick off from next week. So this is happening in central Delhi, and because of that, we are seeing that all the 5-star hotels that is situated in central Delhi, which is in fact a premium area, we are seeing that all hotel rooms are completely sold out, and whatever inventory is left, even the hotel rooms is quite less. So that is why we are seeing a huge surge in hotel prices.
Okay, Danish, thank you so much for getting us those details there from the ground. Thank you so much. And viewers, as India closes its long-awaited trade deal with the US, the N. Chandrasekaran, chairman of Tata Sons, has said that India's trade deals will unlock the world market for Indian exporters. He has also said that he is highly, positive on the opportunities front that will unlock for India post the FTA. Let's listen into that crucial commentary.
EU deal, also the
UK free trade agreement, the free trade agreement with UAE, and now the agreement that we have signed with the US, all are tremendous opportunities. It opens up the world market and also opens up the Indian market, and I'm extremely positive about the opportunities that lie ahead, and maybe that requires a separate meeting.
Whereas the Indian aviation sector is likely to get a big boost from the India-US trade deal, says Arvind Meligari, Executive Chairman and CEO ACUS. And during a conversation with NDTV Profit earlier today, he has added that this trade deal will boom the manufacturing sector of India. Let's listen in.
This is a big boost for the industry, in my view, both from OEM perspective and also India manufacturer perspective. We are a very small portion of the 2% of the global supply chain passes through India today. And opportunity is we'll be 10% of the global market in the coming years. And we have opportunity for us to be there at that stage.
Whereas Japan Prime Minister Sanae Takeuchi ruling coalition swept to a landslide victory in a key early election held on Sunday. Her victory was also lapped up by stock markets as Japan's Nikkei share average surged to a record high on Monday, surpassing the 56,000 levels for the first time in early trading. Prime Minister Modi and US President Donald Trump has also shared their wishes on her win. And with that, it's a wrap on this edition of Profit 360. But please don't go anywhere and stay tuned to NDTV Profit for more news and updates.
Ladies and gentlemen, at the NDTV Profit Conclave 2026,
this will be a $30 trillion economy in 2047.
At this moment, as Finance Minister, what's keeping you up at night?
The uncertainties from outside are still where they were. Can we see this deal through?
We are amongst the first to start negotiating. So our deal is very holistic, comprehensive.
The reason why we wanted to bring in this little increase was more for deterrent purposes rather than for revenue purposes. I propose to raise the STT on futures to 0.05% from the present 0.02%.
There's a buzz of a potential hike that could happen when it comes to options STT, and this could be major negative coming in.
Presenting the all-knowing, all-powerful Tech Guru.
Whoa. Guru? I'm no guru.
Okay.
I'm just a guy who loves his tech.
A show where the mysteries of megabytes and motherboards shall be unraveled.
Bro, nobody talks like that anymore. This is all about connected ecosystems, EVs and AI that you can use in your daily life. That's what we do on Tech 360. Real talk, real reviews, tech that you can actually use.
Tech has changed. So should your tech show.
Agarwal Packers and Movers Limited. Man with the cap. Not 300.
and welcome to KYC. I am Sharad Dubey and you are watching NDTV Profit. And let's start the show about the company which we'll be getting today. But I'll give you some hints, and it's a very interesting company. It's the first shipyard of independent India to build a warship for Indian Navy. That's a big hint I've given you. The second one is it's based out of West Bengal. You must be coming very close to the company now. And also interestingly, the stock has given 1165% return in the last 5 years. And of course, their peers also include bigger names such as Cochin Shipyard and Mazgaon Dock. This can't get much easier than that. It's like walking in a garden, to be honest, and that's also a hint. And the stock in focus in the defense space, shipbuilding, is Garden Reach Shipbuilding. That's the company which we are talking about, and we'll talk about the company in detail about what the outlook is for the industry and the company going ahead. Also, remember why we are getting this company. That's a very important question. The company came out with its Q3 numbers also, and that's the key reason is what led to the strong Q3 numbers. Is it the execution? Is it the margins? That's what we'll be looking at. Another important question will be, of course, the guidance. There is an operational leverage at play, but will the margins go ahead? But there are some concerns also, and that's why we are calling the company is the execution risk that is concerning the entire industry. Has that stopped a bit? And that's what we are seeing in the stock prices also when we compare this space. The order outbook and the guidance, that's the outlook we are looking like for the order book. And of course, the management seems to be very confident when it comes to the order book. The next generation contract on corvettes. Corvettes is a type of a war building ship. It's a bit smaller as compared to the larger ships, but nevertheless, a lot of this is manufactured by this company. Also, let's look at the long-term manufacturing capacity expansion plans. What's it going to be? Will it be brownfield? Will it be greenfield in Kolkata? We'll be looking at all these parameters as well, and that is why we are calling this company. And on the show is going to be Commodore PR Hari. He's the chairman and MD of GRSC, where he will be asking or actually answering all our queries today. But let's just give into the about the company. What's the key details like? We know about it, you know, the people tracking the mid-cap space, the analysts, and even you must have heard about this company. But I'd like to get into a detail about it. It's a defense PSU for the shipping industry. And the second important thing is it's a Schedule A mini Ratna category company as well. We have seen the entire defense space showing a lot of interest both in terms of orders and retail space as well. And remember, it's the first shipyard of the independent India to build a warship for the Indian Navy. There is a lot of history behind this, and this is the only Indian shipbuilder to have 4 distinct shipyards as well. So you see the history is so rich of GRSC and of course the Indian shipbuilding industry, and they have built over 800 platforms including 115 warships for the Indian Navy. That's a very big achievement. And also, if we talk about the other important factors, these are the products which the company deals with. There is frigates, there is corvettes, there is of course fleet tankers and landing ship tank. So it's very much interesting for even a child who is understanding this in KYC about GRSC. But the key products, of course, are the land craft utility survey vessels. That's what we would be looking out for. Also, apart from this, there are offshore patrol vessels and fast attack craft, and more these products would be coming in as, you know, defense becomes a very major theme. And of course, the security of the nation is the paramount for GRSC. But Q3 numbers is important if you're tracking the markets. Q3 sales were near its peak. That's where the concern comes in. The numbers were good, but is it peaking too early? The revenue surge is led by a bell curve execution cycle. That's what the brokerages are talking about it. And the concerns definitely are there whether the peak is there for FY27 when it comes to the sales. Inflow pipeline is robust, but it is distant. It might take some time. If that happens, the cash flow conversions, that comes less because it's a long gestation period business. And the order book stood at roughly 20,200 crores. It was down 7% on a sequential basis, and that is where the concern starts coming in. Remember, these entire pack of shipbuilding were very high valuation stocks, and though most of the valuations have corrected by almost 50-odd%, margins have improved due to the operating leverage that will definitely give to the company's performance. But going ahead, currently the execution part, if you look at it, the management guidance, they're having 10 major shipbuilding projects. So we will be talking about this as well from the management. Looking at the ship repairs, portable steel bridges and naval weapon, that's a new area where the management has stated that the business is good. Also, apart from that, let's look at the next generation corvette contract. That is also on the anvil. So we will be asking the management about the timeline about this important contract and the number which they have given in their presentation in Q3. They want that 50,000 crore mark of order book ending in financial year 2026. That's just 2 months left. So that'll be pretty much a steep hike, coming in from the company itself. Two developments coming in. They have signed a 33 crore order from Ministry of External Affairs. Also, they have signed an interesting order. They have entered into MOU with MSKT Cranes and Components. Generally, we don't talk about cranes when GRSC is in question, but there's a very interesting MOU. And why this MOU has been signed? That's for the marine defense shipyard cranes and associated equipment. That's an ancillary segment, but remember, this is the high margin products when the ancillary services or products come in compared to the main product. But there are key concerns in the shipbuilding industry. That is why it has come out of the investor interest. The first one is the execution risk. That's where the concern lies. And the order flows, they might be hitting their peak. Of course, we saw the sequential numbers also coming down. Other concerns are also that the institutional selling has been seen in the previous quarters. And I'll show you the details in the DIs as well as the FIs, what's happening there. Technical analysts say that sector is expected to remain range bound or maybe a little bit of price correction could come in. So that is something which we will also be looking out for. But there are concerns about this industry. But nevertheless, it's my job to understand and explain you what's ailing the industry. But let's talk about the KYC show. There are 8 ratings where we judge a company. And of course, it's the numbers. There is income statement, balance sheet, cash flow, return ratios where we get the company in. But apart from that, we also see the shareholding pattern, which I discussed. Where is the institutional participation going? And the street cred. If you're holding the stock for 1 month, 6 months, 5 years, how much returns have you made? Valuations, we compare them with its peers. Of course, the company has 2 major peers. I'll get you those information. And analyst tech. Are the analysts still bullish on the stock despite the stock, doing nothing in the last 6 months? All of these queries, I will answer it one by one. Let's talk about the first parameter, and that is the income statement. Of course, remember the Q3 numbers have also come in. And largely, we see how the 3-year CAGRs are there. It's extremely good, 40% plus, be it the income statement, be it the EBITDA, be it the PAT, and see the growth coming in. And that is where the interest lies for the investors. Let's pull up the Q3 numbers also to see what has happened. Margin growth has been significant, and that's what I've been liking. It is an operational leverage at play, but top line growth is also very strong. So income statement, all cylinders are firing, and of course there is no reason not to give any other number to it. And the margins also, that has also gone up to 9.1%. This is a decent uptick coming in. So you see, this can even hit a 10% mark going ahead. And that's what we'll be asking the management. But right now, for income statement, we will be giving it a strong thumbs up. Let's look at the balance sheet. What happens here in balance sheet? Generally, balance sheet of these companies are very tightly done up. And remember, the total equity reserves are very strong. The borrowing, that has actually come down, and that's a good sign as well. But apart from that, we see how the cash flows are. I mean, the cash balance, that's roughly 3,700 crores. Not major change has happened. Net, it is a neutral rating when it comes to the balance sheet as well. There is nothing great about it, but nothing bad about it as well. But let's talk about the cash flows. That's where my concern starts coming in for this type of industry. Remember, there's an execution risk. There might be delay of payments, and that is why the cash flows might look good there, but the concern starts coming here. That is where we see in FY24. Also, the cash flow, this is not total equity. This is the cash flow actually. So just an error. But you just see the flows from operations. It is not a straight linear line. There are a lot of variations, and the business model is as such. That is why. And right now, for the current numbers, of course, the cash flow, I would say, is on the negative side. But the return ratios, let's look at that. Return ratios have been very strong. For a company like this, at least a 20% plus return ratios is necessary. And they have maintained it in FY24 itself. But see the growth coming in. 28 in FY25, FY26 it's around 34%, and it's maintaining it for FY27 as well. So 30% plus is what the brokerages are estimating for the return ratios, and that is showing strength. Let's just pull out the other return ratio as well. ROE we spoke about. Another is ROIC, return on invested capital. That also we see a significant growth is coming in 27% in FY25. Is expected to be around 30% plus for both the years, for FY26 and FY27, and that is where we see the street is very bullish on when it comes to the return ratios. So right now, I would be giving the return ratios a strong thumbs up when it comes to my analysis for KYC. But let's talk about the shareholding pattern. You know, shareholding pattern is very much important, but as of late, there has been some institutional selling. Let's just show you the shareholding pattern, how things have moved. Of course, 75% stake is untouched, which is owned by the government, but the action is here. FIs had 3% stake, and it's largely stable in the month or the quarter ended of December. But the concern is it was 6% here for the DIs in March 2024. And then we see it has come down to 2%. That means a 4% downtake in terms of selling of stake coming in the March month, and then in December also there hasn't been much increase as well. That means the concern is there on institutional selling. FIs are strong, promoters decent, the retail absorption has gone up by 5% from 16 to 21%, but net shareholding has been on the lower side, so it's a thumbs down when it comes to the shareholding pattern. Let's talk about the street cred, and to put that in perspective, street cred is nothing but how the share price has moved around. And remember, if you are a shareholder for the last 6 months or you have entered after that, the entire industry has been under pressure. That's why in year-to-date basis it's been flat, and you could say last 6 months also it's been flat. That's where you might have been trapped had you entered in these times. But if you are a long-term shareholder, congratulations to you. Even for a 1-year basis, if you are holding the stock, you have made 62% returns on your portfolio. And if you're a 5-year investor, the rally which we saw in the shipping stock, then congratulations, 1165% return. So short term, there's a disappointment. Long term, it's a very big joy. So on that basis, I've given a neutral rating when it comes to the street cred. Also, apart from street cred, let's talk about how the valuations pan out. Valuations, they are of course having two immediate peers. There is Cochin Shipyard and Mazagon Dock, where we'll compare the 12-month forward P ratio to give you the perspective. But remember, all of these ratios which are there, they're already, all of them are down by almost 40 to 50% from their peaks. So currently, these are the ratios to look at. Cochin is still a bit expensive. GRSC and Mazagon Dock almost even Stevens. That's around 31 times the P ratio is coming in. But despite it being one of the cheapest, is there actually value in the industry? Will they give the multiple what they were giving this multiple in 2024? I think it will take more time, and because of that reason, I will be giving this a neutral rating when it comes to the valuation picture with the peers. But let's talk about the analyst take. What are analysts suggesting? And it seems like some analysts are on the sidelines, some have given a sell call, and while some still remain positive and give a buy rating. So majority of them are still giving a buy rating, and the stock has corrected or hasn't done much. It's in a range bound mode, in technically speaking, for a lot of months, almost 6 to 8 months. So there is a likely return in the next 12 months for 20%. So that's where I think there is some kind of a hope going ahead. And hold and sell is definitely there as well. So it's a neutral rating from this side. But of course, let's talk about the final rating for the company. You know, we spoke about the numbers, the outlook, the industry, and why, you know, it's the shipping industry is right now out of flavor for the investors. I've given you the reasons, but let's just see on the company specific focus what's there. Income statement has been strong, return ratios has been strong, but the execution risk at times change into, you know, very volatile cash flows, and that is where my concern comes for this company. But moving ahead, shareholding, the institutional participation, especially the DIs, have reduced. Street cred, short term questions. Long term, it has been a massive multi-bagger. On the valuations front, all of the peers have corrected 30 to 40% from their peak in 2024, and analysts are also divided. 4 of the analysts have given a buy rating, but the remaining 3 are still on a sell or a hold. And overall, It's a very, very neutral rating I've given. It's a 4 out of 8 for Garden Reach Shipbuilders. So that'll be pretty much interesting. And of course, joining us would be Commodore PR Hari. He's the chairman and managing director at GRSC, and of course a lot of he has a lot of achievements also under his belt. Very, very good afternoon to you, sir. So first question, Hari sir, is your Q3 earnings. It was a very strong set of earnings which had come in. If you could just give us the key reasons on that.
Thank you, Sharath. At the outset, I think I have a tough task because you have just rated us neutral. 4 out of 8 is definitely in my standards poor score, and my endeavor in the next few minutes that you give me would be to perhaps influence your impression. The Q3 has been good for us. Revenue has moved up 49%, and so has the profit after tax by 74%, and that is that has been an interesting quarter for us. Specifically, why we have achieved good results, or rather, I would say excellent results, is because of the fact that our major projects, that is the P17 Alpha and the anti-submarine shallow water craft, these projects are at a stage where the revenue accrual is at maximum. That is actually the reason why the performance has been good during the quarter. So in a nutshell, the financial year so far, and especially Q3, has been good for us, but I can assure you better times are to come.
All right, better times to come, but the margin front, that has seen a significant up move. Hari sir, I was just checking all the margins all throughout. They have been doing really well. It's almost at the cusp of that double-digit margin. It's at 9.1%, if I am not wrong. Will we see that 10% mark maybe in the next 12 months, 18 months? Is there any lever to it?
See, the major project, that is the P17 Alpha project. As you are aware, we have already delivered one ship ahead of schedule. The second ship is due for delivery in a couple of months, and the third ship also would be ready for delivery during the next financial year. So in the next, that means from now till the next financial year, we will be able to maintain similar margins. And so has the anti-submarine shallow water craft project, that is also a profit-making project. This project has also reached a stage where we are accruing revenue, and so the profit margins, to answer your specific question, we will be able to maintain similar margins in the coming quarters too.
So, Hari sir, if I'm not mistaken, it will be between 9 to 10%, or will we see it going past the 10% mark?
It will be around the similar margins that we achieved in this quarter, around 9 to 10.
Okay, fair enough. But Hari sir, there are concerns in the industry, and that's what, speaking from the market perspective, is the execution risks. There is the execution risk which come in, and at times it impacts the cash flows also going ahead. And that's what's happening in the shipbuilding industry as well. The order flows earlier used to be very big, but now they are small, MOUs are coming. What's your view on it? Is it the industry specific problem which is coming in?
To 5 years. As far as the execution rate or the delivery rate is concerned, I'll just like to put this in a perspective. In the last 9 months, the first 9 months of the current financial year, GRSC has delivered 5 warships of 3 different classes. And I can assure you that in the next 3 months, we will be delivering 3 more platforms, which means in a year, that means in a span of 12 to 13 months, 8 ships is good by any standards, be it domestic or global. And I presume this is the similar condition with all the Indian shipyards. There have been issues, there have been challenges, there have been cascading impact of the COVID, which we think COVID is over, but there has been a cascading impact which affected the supply chain system for over 2 to 3 years. It is stabilized now, and that is why you see good execution specifically by GRSC currently. So I feel that the appreciation or the perception regarding risk in execution need to be put to rest. It has bottomed out, as you correctly mentioned. And again, to put things in, yes, coming from non-defense shipbuilding, both the domestic and export. Just to give you a positive note, our current order book stands at 18,482 crores. This is a reflection of the execution rate. The last 5 years, our order book has never dipped below 20,000 crores, and this is the first time it has dipped below 20,000 crores, and I consider it as a very positive sign. Why positive is because that means the execution is moving along well. When we started this financial year, our order book was around 22,650 odd crores, and currently, as I mentioned, is 18,482 crores, which means we have already in the 9 months accrued revenue, that is our revenue from operations in the 9 months stands at 4,883 crores. And we matched it with an order coming in, small orders, but totaling to around 4,198 crores. What I was talking about, the positive note is that we intend ending this current financial year with an order book position close to around 50,000 crores, as we are in the final stages of concluding the next generation Corvette project. And so we expect the contract to be concluded sometime in March.
Right. And Hari sir, one more question is on the expansion plans. There is a brownfield expansion plan, there's a greenfield expansion plan. If you could just give our viewers the entire picture of, what's the timeline about it and any kind of, the manufacturing capacity going up for the important ships.
Sure. The current shipbuilding capacity is for concurrent construction of 28 ships. And with the ongoing modernization within our geographical limits, which is already going on, we intend increasing it to 32 ships, medium, large and small, by the end of the current calendar year. Yes, we are going in for brownfield as well as greenfield expansion. The brownfield expansion will be across 3 locations within West Bengal. The work has already commenced, and we intend putting these facilities to operational use by the end of this calendar year. As far as the greenfield expansion is concerned, we have formulated action plan for 2 sites in Gujarat. One for a dedicated shipbuilding and ship repair facility, and second, a ship recycling and shipbuilding facility, which is going to be very interesting. But these naturally are being greenfield expansion. We expect this to take shape in such a way as this can be put to operations in the next 3 to 4 years. This is broadly our expansion plan. And with this expansion, both brownfield and greenfield, beyond the 32 ships what I had committed by the end of the current year, our intent is to enhance this to 40 ships, large size ships, to meet the demand that is coming, which is both from the defense as well as the non-defense segment, especially from the Ministry of Shipping.
That's pretty much interesting, and I was just looking at the background where you're sitting, a child in me is just looking at these amazing vessels which are there behind you. But to put in perspective, a lot of international announcements are coming. French president will also be coming, and we know a lot of deals, or you could say tie-ups, we can expect internationally also. So if you put GRSC in the international business perspective, and of course, our products are really strong. So what is your view on it, in terms of tie-ups, going ahead?
As far as international opportunities for shipbuilding, I'll again break this into 2 segments, the defense and the non-defense segment. The defense exports, especially for warships, are government-driven. Most of them are either through line of credit or G2G grant. So here we expect a momentum to garner through the visits and the interactions between our government and the various foreign governments. As far as commercial shipbuilding is concerned, this is where it is directly under the control of the shipyards. As you are aware, we are currently executing a project for a German client for 12 multi-purpose vessels. We started in a very modest fashion. Our initial contract was for 4 ships. Then they saw the progress increase it to 8, and subsequently it is 12 ships now. Now the European clients, the international clients, especially the European clients, are looking at India as a commercial shipbuilding hub. Almost all the Indian shipyards have orders from these European clients, and we expect more opportunities, especially for vessels which are, let us say, challenging in terms of building, like hybrid vessels, neutral energy vessels. So this is an area which we see GRSC getting opportunities, especially for the European market.
Right, Hari sir. Thank you very much for taking out your time and explaining us and clearing a lot of misconceptions which are there in the industry as well. Best of luck for the future and for GRSC as well. Thank you very much, sir.
Thank you. Pleasure.
Well, that was the management for GRSC, and they did clear a lot of air regarding the execution risks in the industry as well, and it was very interesting to have a chat with them. But that's all, folks, for KYC. Stay tuned to NDTV Profit.
Ladies and gentlemen, at the NDTV Profit Conclave 2026,
this will be a $30 trillion economy in 2047.
At this moment, as Finance Minister, what's keeping you up at night?
The uncertainties from outside are still where they were.
Can we see this deal through?
We are amongst the first to start negotiating. So our deal is very holistic, comprehensive.
The reason why we wanted to bring in this little increase was more for deterrent purposes rather than for revenue purposes. I propose to raise the STT on futures to 0.05% from the present 0.02%.
There's a buzz of a potential hike that could happen when it comes to options STT, and this could be major negative coming in.
Presenting the all-knowing, all-powerful Tech Guru.
Whoa. Guru? I'm no guru.
Okay.
I'm just a guy who loves his tech.
A show where the mysteries of megabytes and motherboards shall be unraveled.
Bro, nobody talks like that anymore. This is all about connected ecosystems, EVs and AI that you can use in your daily life. That's what we do on Tech 360. Real talk, real reviews, tech that you can actually use.
Tech has changed. So should your tech show.
Alright team, our new order show is ready. Now we need a promo. Something cool, something sharp.
Well, I'm sure we'll be having outstanding reviews, solid suggestions,
Expert advice, the latest trends. It's a lot simpler. We'll help people make the right auto decision. It's got the cool stuff, geeky stuff, serious stuff, all of it, so that you can discover, decide and drive. I'm Siddharth Sharma and I am your Automate.
New year. New power panel. India market open. Now in its boldest lineup. This is where the trends get tested and stocks get conviction.
I'll recommend a buy call on a stock only when I'm fully convinced on the stock.
Hi, we're talking about Your Money Matters on NDTV Profit, and my name is Alex Matthew. Sometimes it is a good idea to go back to the basics, and today I'd like to talk about balanced advantage funds in the context of what you're seeing and you have been seeing in the recent past. It's not been the best year for equities, and in that context, balanced advantage funds and other hybrid funds have actually done better when you compare them with pure equity portfolios. But at the same time, you have bond yields, and we'll explain this so that everyone understands it, that are unlikely to go too far down, and that means that the capital gains that you would get from fixed income portfolios are not very high. Sounds complicated? Well, that's because I'm explaining it. Let me get you Harsh Kumar, who is a partner at Zvest Financial Services, and I'm sure that he's going to explain it much better. Harsh, thanks so much for taking the time and for speaking to us on Your Money Matters. Let me first ask you, for those people that are unfamiliar with the concept, how do balanced advantage funds work and what is their purpose?
So Alex, there are two categories in hybrid funds. One is called static asset allocation fund or aggressive asset allocation, and second is called dynamic asset allocation fund, which in popular terminology we call it as balanced advantage fund. Now, if I look back in the times, this category was made a distinct category by Security and Exchange Board of India in April of 2018. And most of the funds which have been launched in this categories were actually prior to that. Since 2012, we have seen a good amount of traction of these funds. And the inflows in these funds have been significant. So if I just see the current AUM of these funds as a category, that's around 3.2 lakh crore. Now, if I go back to the static hybrid category, the AUM there is around 20 to 25% lower, which means these funds are becoming mainstream as far as allocation is concerned. Now, what are these funds? These are the funds where there is a full flexibility with the fund manager to take equity exposure between 0 to 100. Though generally we have seen that there is a more moderate range in which fund managers operate, unless you have a situation like COVID where there is a sharp correction in the market and some funds would have gone as high as 75-80% also. But broadly, they remain in the moderate range. Now, how do they decide how much debt and equity to have? So they have all their proprietary models. There are certain variables which are fed into the proprietary model. These variables could be pricing multiples like price to earning, price to book. It could be certain momentum related variables. It could be even certain special situations which could be a part of capturing the sentiments, which can help decide how much debt and how much equity should be a part of the portfolio. Now, in this category, what we have seen is that the decision between debt equity percentage is generally automated and fund managers don't have too much of a discretion there. But which bonds to buy and what equities to buy, that is a discretion of the fund manager. Now, there are two broader categories of these funds. One is called pro-cyclical funds, where if the market is trending high, the fund managers increase exposure to equity and vice versa. And then there are certain counter-cyclical funds where if the valuations are cheap, then equity allocation is increased, and if the valuation is expensive, equity allocation is reduced. So you can say that balanced advantage funds are more like automatic car, where you don't have to worry about changing the gear, and when to move from debt, when to move to equity and vice versa is decided by a team of experts. And they have been doing a very, very good job over the last few years. One caveat here I would want to say is that the fund managers in this category, they have to maintain 65% allocation in equity or in arbitrage to ensure that the taxation is equity taxation.
Mm-hmm. And most people do that, right, Harsh?
Right. They do that because otherwise, one of the key advantages of these funds is tax efficiency, which goes away.
Yeah. Just to drive home that point, a lot of people have stopped investing in pure fixed income funds since the government changed the treatment of these funds and the returns that you get from them with regard to the capital gains tax, right? You would be paying slab rate on all returns from these funds, irrespective of whether it is capital gains or interest income. And that is an important clarification, of course, that has caused a lot of people to shift their allocations. Harsh, you would know this. So therefore, what is the ultimate expectation on returns when you invest in a balanced advantage fund? What is the ideal time frame that you would want to keep or you should keep for a balanced advantage fund?
So, Alex, let's look at the data points to arrive at that number.
Okay.
Now, when I was saying that most of the funds got started after 2012, so we don't have a data for last 20, 25 years, but let's take the data for last 10 years. And in 2015, we had close to around 11 funds which were there in the market in this category. If I do a rolling 3 years analysis, there are two funds which had 4 to 5% negative instances of returns. And one fund was HDFC, another one was Bank of India. And here again, I would want to tell audience that HDFC Balanced Advantage Fund was not dynamically managed till around 21, 22. And that's when they started managing it dynamically. So it historically used to have higher equity allocation. And it was managed by Prashant Jain. When Prashant moved out and a new team took charge of this fund, they started managing it dynamically. So this could be the reason of that fund having negative reporting numbers over a 3 years time period. But even if I look at other funds, there have been 1 to 2% instances over 3 year rolling period where the returns were negative. Now we did the same analysis for 4 years, and all the funds had 100% instances of positive return. So if I'm advising someone that your principal would be protected, then going by historical data point, 4 year is the ideal time frame, or I would say the lower time period in terms of the holding period which an investor should have. Now let's come to the returns. If I look at returns over 3 years rolling, 4 years rolling, 5 years rolling, on an average basis, it ranges somewhere between 9.5 to 10%. And most of the fund houses, they tell that these funds are not relative return products, which means you don't compare it to Nifty large cap or mid cap or small cap, but look at it as an absolute return product. And these are all seasons products. So if you are looking at a return, going by historical data, though history is not an indicator of the future, but if you are okay with 9.5 to 10% kind of a return, and if your holding period is 4 years and above, then this is a beautiful category to be a part of your portfolio. And one more thing I would like to clarify here, Alex, you were saying that most of the people have started moving from pure debt funds to this category. That I would advise against. And I'll tell you the reasons for that. If I look at the volatility of this category in standard deviation terms, if you use the term, is between 5% to 17%, where funds like SBI Balanced Advantage Fund would have a volatility much lower at around 5.5%, while Nippon and HDFC trend at a higher level of volatility. So please don't consider it as an alternative of debt fund. There are other funds which are like debt plus arbitrage and income plus arbitrage, which you can look at for that space. But this should be looked as slightly aggressive variant than debt, but conservative than equity.
Okay, I just want you to explain very quickly, Harsh, that point for everybody that is not familiar and well versed with mathematics or investments. When you said standard deviation of 17% at the higher level, how do you explain that in the context of something, for example, that has a return of 10% compounded annual growth rate over a 5-year period? In that context, what is the meaning of a 17% reading on standard deviation?
So let me take a simple example to explain that. Let's say you are driving from your home to your office, and every day you are taking 20 minutes. One fine day you are rushing, you are late for your meetings, and you say that normally I drive at a speed of 60. Today, let me drive at a speed of 100. Maybe you will reach well ahead of time, but there is a small possibility that there could be accident on the road also, because you are not comfortable driving at that speed on a daily basis. So in financial terms, standard deviation means how much are you going away from the mean. So if I take a simple instrument like fixed deposit, if you're doing fixed deposit at 7% per annum for next 5 years, you know that on day 1, your return is 7%, on day 10, your return is 7%, on day 100, your return is 7%. So you don't have any standard deviation because your return always is 7%. But funds where today's return could be 5% and tomorrow it could be 10 and day after tomorrow it could be 2%, that means they display a higher standard deviation, which means the behavior is not in sync with the mean. It keeps on going away from the average return.
Yeah, very well put. And a simple example in this case is that if you have gotten a 10% return, the standard deviation is 17 or thereabouts, there have been periods in that time frame when you have also gotten negative returns on that investment that you have got. So you need to be okay with that period of uncertainty and negative returns. But coming back to the point on balanced advantage funds, Harsh, you described certain behavior patterns or return patterns over the course of the last many years, and you actually looked at it in rolling returns terms. But I'm curious, you mentioned the overall assets under management. It's a pretty large category. What are the largest schemes and what is the return profile that they have generated?
So Alex, this is a very, very interesting category. And why I say that, because in this, the leaders have the maximum share of AUM. So again, going back to my number of 3.2 lakh crore of AUM, the number one fund in this category in terms of AUM is HDFC. The AUM is close to around 1.05 lakh crore, which is 33% of the entire category's AUM. So you have 35 funds and one fund is 33% of the total AUM. Second fund is ICICI. The AUM is around 70,000 crore, followed by SBI at 40,000 crore. And then you have Kotak and Edelweiss at 17 and 13,000 crore. So if you take these top 5 funds, 77% of the AUM is with these 5 funds. Now, generally you would believe, or the intuitive feeling is that when the AUM increases, then performance becomes a drag. But that's not been the case in this category. Let me illustrate with numbers. If I look at last 5 years, trailing number, not a rolling return, HDFC and ICICI have been the leader of the pack. If I look at last 3 years, HDFC, ICICI, and SBI has also participated in that. So these three have been the leaders. If I look at last 1 year, then the leader was ICICI, followed by SBI and ABSL. HDFC lagged a bit in last 1 year, but that's a very small time period to look at. If I look at these funds on which have delivered better return, most of these funds have been counter-cyclical. Over last 1 to 2 years, these funds have delivered better return. One reason could be that market was not in a momentum, market was very narrow, and funds which were following pro-cyclical approach, they lagged versus funds which followed counter-cyclical approach. But one thing is very clear. If I look at last 1 year return of ICICI Balanced Advantage Fund, which is the top fund in the category in terms of performance last 1 year, it is 12%. If I look at ABSL and SBI, the return is 10%. Now let's look at the return of Sensex. Sensex delivered 9% return. If I look at Nifty mid cap or the average of mid cap funds, the return was in the range of 4%. If I look at the average return of small cap fund, it was minus 4%. So I'm giving you a lot of data points, but the point I'm reiterating is that the asset allocation and risk management can deliver better return in times when the market is very range bound, when the market doesn't have a clear leadership, and that we saw in 2025 when these funds delivered much better return than full-fledged large cap, mid cap, or small cap funds.
Okay, so now here's the clincher and the end of the conversation. But Harsh, it's important to identify where this fits, because you can buy a Lamborghini, but then if you have to drive from Bandra to Borivali, then it may not make sense. So therefore, where does it fit in your portfolio? Who should buy it?
So first and foremost, Alex, like I mentioned earlier, the profile of this fund is moderate. It's not a conservative fund. So it's not an alternative of debt. It's not an alternative of income plus arbitrage. So one thing should be very, very clear, that you are getting into a fund which has equity, which has volatility. The average volatility though is around 9%, which is not very high, unlike small and mid cap funds. From a behavior point of view, if you ask me, investors who don't want to put their head on how much debt and equity they should have in the portfolio, it's good for them. Investors who are confused as to whether they should enter into the market today or tomorrow or after 1 month, what kind of valuation multiple they should track, it's a good category for them because they can enter into this fund practically on any given day. Third category of investor is people who are hands-off investors, who check their portfolio once in a while. This is a good category because it will not disappoint you on the negative side. If you get into some other category like thematic fund or something, and if you don't track it diligently, you could have a very bad experience even if you hold it for a longer period of time. Now let's look at the investor profile on which kind of investor should be getting into this. First-time equity investors, it's a good category for them. DIY investors can look at this space because you don't need to apply too much of a brain before getting into this. Investors who are going to retire in next 3-4 years and are looking for an anchor fund for systematic withdrawal plan, this is a very good category. And somebody who has a very important goal 4-5 years down the line, like, goal of marriage or education, they can load their portfolio slightly higher toward this. And I would say that this is not a product which is not for everyone. It is actually a product for everyone, and it should be a part of core asset allocation for most of the investors. Returns, we have discussed that the expected return should be 9.5% to 10%, and a holding period should be 4 years plus.
Great. I think we've covered a lot of ground. Harsh, thanks so much for taking the time as always. Pleasure speaking with you.
Thank you. Thank you, Alex. Thanks.
Passive investing. It doesn't necessarily have to be boring. In fact, it can be interesting, effective, and great for your portfolio. And who better to talk about this than Rishi Kohli, the CIO of Jio BlackRock AMC. One half of this entity is a global expert in passive investing, and obviously that will rub off on the investment decisions that you make and the decisions that you make with regard to construction of products. Talk to me, and first of all, thanks so much for taking the time, for coming by. Talk to me about the suite of products that you've currently set up, and there's another one that's closing today. So what does the suite look like right now, and what's the roadmap going forward?
Sure. So yes, this is the 13th fund whose NFO is going on and closing today. We started back in June, July with the first suite of funds, which we call cash funds globally, which is liquid money market and overnight fund. And then we started the index funds, the equity index funds in August, which was Nifty, Next 50, small cap, mid cap, and also a small GSEC 8 to 13-year fixed income index. And then we launched the first active equity fund, which was the Flexi Cap fund, based on BlackRock's global systematic active equity approach. Then an arbitrage fund, and then low duration and short duration funds early in Jan. And now this is the sector rotation fund, which is the second active equity fund that we are launching, which is, the NFO is closing today. And the thought process has been more like, how would investors invest, right? Especially first-time investors. Because the whole goal of the JV has been to increase financial inclusion across the length and breadth of the country, using Jio's digital, reach as well. So, anyone who's not invested in mutual funds, but everyone in India has money in FDs, first they will move some of that money from FD to a liquid fund kind of thing.
So, but specifically for you and the kind of flows that you've seen into your own schemes, and what you're trying to do is quite interesting in the way that you're distributing the product. What is the kind of flows that you're seeing? Because you've got already one active fund. Today, the one that you're looking at is what somebody would normally put in a satellite allocation, right? So, how is the positioning been working out for you?
Yeah, so largely been good. Taking on from what I was just saying and what you just asked. So, post those cash funds, why index and then why active equity? Because that's how the transition for a new investor would happen, right? And in line with that, what we are seeing, not only in terms of the initial NFO related data, because that, sometimes initial funds, there'll be more excitement, going forward, there may be lesser excitement, but I think the digital adoption, since we were digital and direct, how that has happened and then how that is leading to regular flows is honestly what has been more interesting for me. And there, for both our equity index funds suite and the Jio BlackRock Flexi Cap Active Equity Fund, pretty consistently we've been getting flows, every day through the digital channels.
But is it primarily SIP flows or is it lump sum flows?
It's a mix. But yes, SIP is a decent percentage, and that's why I think the SIP book is growing pretty well compared to what any other AMC has seen in the first initial phase of the first 6 months. Just to give some numbers and context around it, the FlexiCap fund at NFO was just under 1,500 crores, around 1,470 crores or so. And as of today is 2,700 crores.
Okay.
And little bit is due to performance, but a large part of it is obviously consistent flows because markets have been pretty range bound since then.
Yeah, single digit, I would think, right? So talk to me a little bit about the sector rotation fund, because one would assume that it fits into, like I said, that satellite allocation, because you would be able to take, my assumption, concentrated bets, relatively speaking, sector-wise.
No, I'll explain
how it works. So it's supposed to give you a diversified approach to sector allocation, but how does it work?
Yeah. So see, the background to that, I'll just explain for us 30 seconds and then go into the product. So globally, there's a lot of research. Obviously, BlackRock has done a lot of it, but even other large global AMCs, that there are three distinct sources of alpha. One is stock specific, second is sector specific, and third is what is globally called as factors or style specific. India, you have largely stock focused funds. Factor style is relatively recent, more participation of passives right now. Very few active funds and very mixed performance so far, right? But again, globally, that is a very large piece. And sector specific is another third area, which is sort of non-existent in India. So which is why when we did our product suite, again, going back to the earlier discussion also, we said that, okay, this is a big gap. This is a big source of alpha globally and in India as per whatever simulations we've done. So why don't we bring a product out in that space? So what it means is that, let's say you as an investor have a lot of stock specific funds in your portfolio. You're diversified because you may be doing some flexi, some large, some mid, or something else where you are trying to be non-correlated. But a sector focused alpha approach is completely non-correlated to whatever else you may have in the portfolio, which is stock specific. So which is why it deserves sort of a place in any portfolio. Why we say sort of satellite compared to flexi is because flexi can be the first active equity fund for any new first time investor, for example. That investor, once he wants to move to other funds, he should look at sector.
Sure.
But everyone like you and me or others who have equity portfolios, which has other funds in the portfolio, for them, sector becomes a good next step rather than allocating to some other sector-specific fund.
So explain how the construction is done.
Yeah, so here, obviously, the other overarching theme we have and the differentiation we have at Jio BlackRock is the fully systematic approach.
Right.
Because I mentioned systematic active equity of BlackRock earlier. That is a very large division that BlackRock has globally on the active space and has had very strong performance over the last 10, 15, 20 years. So FlexiCap was our first sort of fund completely on the systematic active equity approach. Sector rotation also takes the key elements from there and then adds some sector-based allocation tool rules around it. So what we do is that globally there's the GICS industry classification. And these are typical, financials and auto and consumer and whatever, which is what we typically all talk about as sectors. Then there's a level 2. So when you go to level 2, currently there are 25 sectors. And here a simple example is financials, where, you have banks also, NBFCs also, and insurance companies also. Whereas these are 3 different sectors, right?
And capital marketplaces.
Yes. And these are different sectors actually. So when we go to level 2, we are able to do that analysis separately and treat them separately. So which is why we go to level 2, because that gives us more granularity and we can compare, etc. So we are using that level 2 classification, and out of those 25 sectors at any point in time, we will have 17 or 18 in the portfolio. So it is a very diversified sector approach that way.
Okay.
But coming back to your question on how active it is, etc. So in those 17, 18 sectors, there will be very active underweight, overweight calls being taken. So compared to the weightage a sector has in the benchmark, we will go from plus minus 10% on it. So for example, if a sector has a 10% weightage, we could be 0, we could be 20. And this overweight, underweight for all those 17, 18 sectors on average in the portfolio will change every month.
What is the determining factor for those changes?
And then everything that a typical fundamental macro analyst looks at, and many other obviously high frequency variables, because we look a lot at alternative data. So at a high level, there are 5 buckets. Valuation is one, growth and quality combined into the second. Third is analyst sentiment. So anything and everything you do around analyst estimates, target price changes, upgrades, downgrades, all of that we put as one separate bucket, because systematically you can actually harness that alpha around it. Fourth is broadly momentum. Momentum also includes industry momentum, relative momentum, seasonality kind of things. And also alternative data like job postings, because there is some momentum on whether the job postings are increasing, decreasing, right? And the fifth one is a macro bucket.
Okay.
Because obviously, based on where you are in the macro regime, you will have certain sectors doing better or poorer.
Yeah.
So
like,
that is...
For example, banks being preferred now over NBFCs because we're at the bottom of the rate cut cycle.
Yes, potentially.
Interesting.
So things like that, right? So obviously macro is an additional thing which was not there in our FlexiCap, because that was bottom up, that was doing analysis at every stock level. Here, because it's top down, we are going sector down.
Sure.
So therefore macro becomes a very important bucket. The other 4, somewhere the signals are similar to what we use in Flexi, is just being constructed separately.
So very interesting. So therefore it's not necessarily, it's not right to how is this classified? Where does it fit in your classification?
So that is driven by SEBI.
Yeah.
So this is under thematic.
But it's okay, which is why my misunderstanding when I initially asked you about this, it's not, it doesn't function like a thematic fund.
So see, whatever you know, how SEBI classifications
weightage
are
that
there.
you would have? What is the maximum weightage that you would have per sector or theme in that fund?
Yeah, so I think banking right now has the largest weight as per that sector too also.
Yeah.
I'm forgetting exactly, but somewhere in the 21-22% zone.
Okay.
And that can go plus minus 10, as I said. So that
Sure,
could
but
be
that's
12
still-
and that could be 32.
But 32 is okay, is the weightage that it has on the Nifty 50, so it's not really, or thereabouts.
If the model wants to go
I'm
over
saying,
it.
I know.
Yeah.
But it's not that much.
Yeah.
It's not like a BFSI sector fund or thematic, BFSI
No, not at all,
thematic fund,
not at all.
Where everything is
Yeah.
that.
And that's the goal, right? So when I'm saying 17, 18 sectors out of 25, it is already very widely diversified.
Yeah.
And then we are saying very active, overweight, underweight, changing every month.
Very interesting. Okay, fascinating conversation, and I think we've spent more time talking about this new scheme that you have, but exciting times, and thanks so much for taking the time.
Thank you. Lovely talking.
That brings us to the end of this edition of Your Money Matters. Thanks so much for watching. Let us know what you think, and if there's something that you'd like us to talk about, let us know in the comment section, and we'll take it up. Stay tuned. This is NDTV Profit.
Ladies and gentlemen, at the NDTV Profit Conclave 2026,
this will be a $30 trillion economy in 2047.
At this moment, as Finance Minister, what's keeping you up at night?
The uncertainties from outside are still where they were.
Can we see this deal through?
We are amongst the first to start negotiating. So our deal is very holistic, comprehensive.
The reason why we wanted to bring in this little increase was more for deterrent purposes rather than for revenue purposes. I propose to raise the STT on futures to 0.05% from the present 0.02%.
There's a buzz of a potential hike that could happen when it comes to options STT, and this could be major negative coming in.
Presenting the all-knowing, all-powerful Tech Guru.
Whoa. Guru? I'm no guru.
Okay.
I'm just a guy who loves his tech.
A show where the mysteries of megabytes and motherboards shall be unraveled.
Bro, nobody talks like that anymore. This is all about connected ecosystems, EVs and AI that you can use in your daily life. That's what we do on Tech 360. Real talk, real reviews, tech that you can actually use.
Tech has changed. So should your tech show.
Alright team, our new order show is ready. Now we need a promo. Something cool, something sharp.
Well, I'm sure we'll be having outstanding reviews, solid suggestions.
Expert advice. The latest trends. It's a lot simpler. We'll help people make the right auto decision. It's got the cool stuff, geeky stuff, serious stuff, all of it, so that you can discover, decide and drive. I'm Siddharth Sharma and I am your Automate.
New year. New power panel. India market open. Now in its boldest lineup. This is where the trends get tested and stocks get conviction.
I'll recommend a buy call on a stock only when I'm fully convinced on the stock. With a table thumping buy.
And when the street wants the levels, he brings the chart.
Charts speak the truth, and I deliver the levels with no frills.
Parag Thakkar and Kush Bohra are now part of the morning crew with Tamanna, Neeraj and Alex. Same show, sharper voices. Every morning on India Market Open, your favorite market show just got better. On NDTV Profit, for your profit.
Hi, I'm Tamanna Inamdar. Watch me on NDTV Profit.
context for the NDTV Profit Conclave happens in a setting where India and the United States have just announced a trade deal, the joint statement put out literally hours before now. As finance minister, if you were to look at, say, growth numbers for this year, now that you've got these positive tailwinds that are lifting spirits, to what extent would you be willing to revise GDP growth numbers? Because you've got now this very strong tailwind, because earlier it was dragging growth down. Do you think this acts as a trigger for growth? And is that something that leads you to potentially raise the estimate of how fast you think the economy will grow? That's what I picked up from the chief economic advisor. He was saying like 0.4% tailwind on account of the trade deal. What's your sense as finance minister responsible for our economy about how the trade deal impacts your vision and outlook towards the economy, ma'am? Welcome.
No, every trade deal is important. And it certainly lifts the spirit of the exporters and people who are looking for newer markets and so on. And if the chief economic advisor has given you a number, go by that. I normally don't suggest any number. We work for it.
Interesting. You know, that's the other thing that we've seen, ladies and gentlemen, in the last several years with the finance minister and her top economic team, a conservatism when it comes to setting projections and growth numbers. Is that deliberate? Because one is to aim higher and then, constantly try and chase those high targets. The other is to be conservative when you're setting targets and to, delight on the upside. So is that something that you're trying to do deliberately?
I try being realistic. It may be perceived as being conservative. But I think there are areas in business and commerce which can err on the side of being conservative. Banking, finance. These are areas in which you really can't be too flamboyant or you cannot be too over-ambitious without realizing where the facts are. So, if I were to assess the numbers I've given all these years, I would say I've always been realistic.
What's keeping you up at this moment? Last year, potentially the trade turbulence, the unexpected nature of some of the comments coming globally and therefore the impact it has on the Indian economy, the impact it has on investment outlook would potentially have been your biggest risk factors. At this moment, as finance minister, what's keeping you up at night?
Well, the uncertainties have not gone away yet, particularly the external uncertainties. We keep strengthening domestically our markets, our manufacturing, the MSMEs, support agriculture, and so on. But the uncertainties from outside are still where they were. In fact, even more, I suppose, highly volatile. So that is still a concern for me.
Okay, I'm also going to get some of my colleagues to ask questions. We'll start with Shrimi Chaudhary, who covers the finance ministry for us. So Shrimi gets to ask the first question. Go for it, Shrimi.
Ma'am, just wanted to understand with this tariff deal in place now, we got some certainty here. Is it a bit perplexing or confusing for you that with the kind of growth number we're estimating and we're projecting, still we are seeing the FIs outflows, anemic FDIs, I would say. Is it confusing for you?
Seema, I think I answered this question even earlier. See, the recent couple of years have revealed something which probably was lying under the carpet, but then obviously now they're all coming out. And I'm referring to the fact that fund flows internationally seem to have more than just the commercial considerations. Economies are doing well. You have some economies doing really well and sustaining their performance over the years. Then you have every such indicator which should draw funds towards it really being on an uptick. Even then, the flow is not a flow. Sometimes, I wouldn't say it's a trickle, but sometimes it doesn't flow as much as you expect them to. So I strongly believe, and there are many who would agree, and there's very little reason to suspect that this particular assumption is wrong, or this particular not assumption, my conclusion. Fund flows have more than just the commercial interest in their mind.
So you're saying fund flows are as political as they are economic?
Strategic interests also seem to be one of the very important factors. Otherwise, the economic survey was right when it said every macroeconomic indicator for India is at its recent best. And it's been so literally for the last 4 or 5 years.
But can I counter argue to say, because my batchmates who are investment bankers in New York or London, and even if they're of Indian origin and very bullish on the Indian economy, and I ask them, what's your outlook to India? At this time, India doesn't have much of an AI play. So that's one thing which holds flow. Secondly, the rupee has been depreciating versus the dollar. And by the time they take the money back, because for them, it's about how much returns can they generate sitting in New York. In that context, they're upset still with the long-term capital gains tax which is imposed, saying that impacts to some extent they feel their outlook to India, and the depreciation of the rupee versus the dollar, and the fact that India, in their view, doesn't have much of an AI play, which is where a lot of the funds are going at the moment.
Rahul, I don't deny whoever has given you this assessment. It is probably their own assessment, and they perhaps deal with their funds with these factors before them. But there are equally big fund managers and people like JP Morgan who come, their global head who comes to India and would say probably not what they have said, and they would say India is the place to be, India is the place to do this, and so on. Now on the AI play, I'm not convinced about that, because AI for every country has its own little calibration. Over and above the AI which is globally required, we have the manpower which is absolutely at it, at a high end. We are trying to give that kind of an exposure to AI even for the young fellows who come out of the college or from higher secondary, each for their levels. So on AI, I'm not sure, probably excluding China, I'm not sure if there's any country which is gearing up its manpower to be adept at AI as we are doing. And I can say this with a sense of confidence because you hear it from people who are looking for talented people who can be at various stages of AI.
No, their concern about the public markets is the lack of an AI play in terms of because a lot of the funds have gone towards the big companies which are at this moment building the data centers or the chips.
It's money coming only for AI. Come on, Rahul.
A lot of the flows have been in that direction over the past.
Never mind. You can always score a point on that. But I think India has still a lot of macroeconomic factors based on which till 2 years ago fund would come. But after a certain tightening up on certain other considerations, inclusive of sanctions which are happening, where tools are getting weaponized if a country asserts its sovereignty.
I think that's a very important point the finance minister makes. And of course, sitting on the sidelines of a match and doing commentary is the easiest thing for you and me. But once you're in and that's what you pick up, that's very important. The fact that flows are not just flows.
I'll add to it. Countries like Canada, their pension funds. Countries like Norway, their sovereign wealth funds, and so many others have been in touch with me, and I am actually being invited to go there, and I shall be going sooner. Are they also not affected by the AI consideration? They shouldn't be calling us at all. So different reasons prevail for different funds, specifically in the last minute, to say, all right, I won't go to India or I will go to India. The larger consideration is the return on your investment. India does give it, and that's why many of them booked their profit and went out. And you would naturally assume that return on investment is the primary consideration on which money flows.
Of course.
But no. So what else is there? something beyond it.
Kahani mein geopolitical twist. Okay, I'm going to take a question from Tamanna Inamdar, who runs NDTV Profit. Where is she? There she is. Can we have a mic brought up to her, please? Tamanna, go for it. And the others can also keep their questions ready and warm, and we'll try and give as many an opportunity.
Important point of maybe fund flows being used as a geopolitical tool, like we've seen tariffs being weaponized. But I want to ask you a question from the domestic market point of view. There were lots of hopes for some kind of relief on long-term capital gains tax, with the thinking that it may not happen. The STT increase did see some reactions from the market. Just want to understand your thinking, because when there have been increases in the past, people have still continued to trade in large numbers. Is this truly prohibitive, and will there be more action going forward if you want to control this satta, as you called it?
I'm not sure it will be prohibitive. But that doesn't mean I'm indicating that I'll come with more. Not at all. But if you look at it, I have not touched anything other than the futures and options. I'm not indicating I will. I'm not touching anybody. And the reason why we wanted to bring in this little increase was more for deterrent purposes rather than for revenue purposes. And it's not going by anecdotal examples. Even SEBI in its study found that 90% of them who engaged in futures and options lost money.
Ma'am, can we engage in a philosophical debate on this? I see where you've come out on this debate, that by raising STT you hope to deter active participation by small day traders in the futures and options segment. Fair enough. The counter to this is, these are adults, they're spending their money, they'll burn their fingers, they'll learn their lesson and they'll back off. By government intervention of this form, you don't necessarily impact behavior. That, for example, they'll find other ways. We saw this with crypto, multiple other geographies, VPNs being deployed, the same purchases in cryptocurrencies happening outside the Indian geography. So the government loses out on that tax as far as behavior is concerned, but the behavior doesn't change. Yet your effort is to signal deterrence. To what extent do you think it works?
That's why I said it's not as if this is going to be the one pill which will solve the speculative tendencies. I'm not suggesting that it is the one and only thing which can address it, and therefore I've done it. But equally, it's also something which very many people have said, is the government going to just look the other way, even as this is going on? And if study-based responses are coming, wouldn't you want to act? Other than the regulator themselves acting. SEBI would do its own and I would do my own. SEBI 2 days ago has said, no, we don't intend doing anything at this moment. And I'm saying I have no further intentions of doing anything more. We'll have to try.
What's your assessment of the efficacy of your interventions on cryptocurrency and real money gaming? Has it had the impact you thought it would?
At least I'm trailing them, am I not? At least I know which are the ones who are going and where is it going. At least I know to track it.
But when I speak to young companies, they say, we could have had these kind of valuations, we could have built this business, it's going to geographies where it is allowed, they are making the money and we are losing out in these technologies and in these sectors.
Let's understand that. When if it is all of them are going out and I have to get them back because they are Indians, and if technology will still not defy borders, I can get them back. The same business from here with no borders because technology, or the same business going elsewhere because no borders will serve this country as well. It's a truth. Technology doesn't care for your geographical borders. So in order to keep them here, I have to compromise on tax is one thing, and second, compromise on even detecting what is happening there. Automatic disclosure is not happening. People are not saying, okay, I'm going to go onto a platform and play with cryptocurrency. Are they going to say it to me?
No, but those companies will be here. Those companies, their databases, they'll be here.
Very well, I've heard this argument and there are still a lot of companies here, despite my TDS and TCSs.
Okay. I'm going to get Devna Mehra to ask the next question. Can we have a mic brought across to her, please? Yes. Go on, ma'am.
Yeah, good evening, Honorable Finance Minister. And even though I'm from the capital markets, I'm all for this STT increase that you've done. My tribe might lynch me for that, because it is not just that 90% of the people lose money. SEBI data shows the less educated lose more money. People earning less than 5 lakhs lose more money. People outside metros lose more money. So it is really the people who can afford the least who are losing the most money. And the wonderful part of the budget, of course, was that you've maintained the capex, which is both for capacity building besides the direct impact.
Question.
I'm just coming to the questions because that's deriving out of the capex. Which is both for the listed space and otherwise. But on a lot of the revenue expenditure side, I see that you've budgeted either a very low increase or even a decline. So what is changing in the economy that enables you to do that?
Not changing in the economy, it's also since the 14th Finance Commission, 14th, 15th and now the 16th, an assessment of the schemes, assessment of some of the revenue expenditure has been going on. So if allocations are lesser, it's also because I'm entering a new Finance Commission cycle. And I'm also entering a new Finance Commission where some of the orientation towards how to fund schemes are also being discussed with the states. So many of the things which were long overdue are being done now. Okay. That may not be the answer for every specific head of account on which come under the revenue, but principles like that govern us in starting from a low number. If necessary, we'll increase it as we go along.
I'm going to get Jay Kumar to ask the question. Go for it, sir.
Honorable Finance Minister, one of the liberalization moves that has not even been talked about, but probably is going to have the most amazing impact on the economy in general, is the quiet way in which banks, foreign banks have been allowed to come in and take majority stakes here. Just a rough calculation is about $10 billion of equity just in a few deals announced. Is the harbinger of many more things to do, many more things to come. That, along with the borrowing capability of theirs, means almost a $70-80 billion injection of credit into the system. I think the budget could have given a sign of lower interest rates by actually reducing the gross borrowing and making the rates tick lower, because the only thing, if you see inflation is low.
So question.
I'm just coming to it. This would have been a good time to signal lowering of interest rates. Maybe, I'm just qualifying that, maybe that was one thing which was missing in the budget, where a gross borrowing figure, for some reason, was higher than what the markets expected.
I agree. But I didn't have the luxury, is what I want to tell you. I didn't have the luxury. If you're just looking at the numbers and saying that could be, I will agree, if ceteris paribus. But the global uncertainty since 2022 has kept the 3 Fs as a hot boiling issue. Fuel, fertilizer, food. And if this uncertainty continues, at least on 2 things India is very dependent on external markets. Fuel, fertilizer. I import huge quantity of fertilizer. Of course, I want greater rationalization if we can, without giving the farmer any costs for worry. He should get as much fertilizer as he wants. But there's also this question of how much is getting pilfered, how much is going into plywood industry or any other industry. But with all that said, I can't afford not to have enough stock of fertilizer. So such uncertainties also make me want to be sure.
If I may, the divestment could have been the route to a conscious attempt to raise equity, which companies do when they're indebted, rather than the borrowing figure is the only suggestion here.
I fully agree, and on divestment we are still working. We shall be doing it. And if at all I'm able to reach that kind of a level even by mid-year, I'll review what my borrowings should be, which is anyway done once again at that stage, before we announce the next half borrowing calendar.
No, so let's spend a moment on asset monetization, because you've now set a target of 80,000 crore rupees for the DIPAM division to be able to monetize government assets. Part of it to come from IDBI, which you've announced. What are the kind of timelines you've set for your team to be able to get the IDBI monetization done? And secondly, land monetization of central public sector units. Thirdly, like we saw with Air India, are we now, because you've been working on it for a while, are you now working towards a zone where the government feels confident to be able to push through strategic disinvestment of other central public undertakings which you don't think the government, especially non-strategic areas where you don't think the government needs to be in that business?
First thing, non-strategic areas, strategic areas, that differentiation is gone from 2021. Every sector will have private sector come in.
Sure.
And government's presence in non-core sectors will be to the minimum. In fact, non-core we can be completely out and core will be to the minimum. So that's made clear. And the two kinds, where your holding is already 90%, you can always come down 75, 60, 50. An economic survey said, why don't you come down to 26 now that the voting rights are very clearly demarcated by defining, redefining? I'm not even talking about it at the moment. There's enough and more for me to do in terms of getting public float into some of the public sector undertakings, which are sitting with 92, 98% holding. The other is already cabinet approved items, which will have to be fast tracked on to be totally sold off or privatized. We will continue to honor that approval given by the cabinet. I'll be taking that up. And land monetization, in fact, I'm not sure the report is out yet. Niti Aayog had done a study on land monetization since after the pipelines were announced. And I think the report really finds that quietly a lot of good work has happened. Once those numbers are out for you all to analyze, study, you'll know that the government has been performing even on land monetization. It wasn't as if I announced the pipeline and left it there. Quite a lot of work has happened, and I'm glad Niti Aayog has come up with the report.
Okay, I'm going to get Rahul Bhatia of Maruti Suzuki to ask a question. Can we have a mic sent across to him, please?
Honorable Finance Minister, I have to really compliment, and I go back to the GST landmark reform, a historic reform where you had made a remark, virtuous cycle of growth. I can tell you from industry side that we are actually seeing that happen. We have to accelerate our capex cycle in order to create more capacity to meet the demand that has been created, and it's a phenomenal jump growth rate. The second part is...
So question please.
I'm sorry. I'll still dwell for... Okay. The budget, we are in a rare Goldilocks situation, which we say high growth, low inflation, and coupled with this virtuous cycle of growth. What is the downside that you see now? What are the risks? I mean, we can see everything positive from here on. What risks should we be concerned about now?
Risk is the external challenges. But equally, I would, since you are asking and you're from Maruti, I would say this. India's private sector should participate in India's growth. No longer any other reason can be given as a valid reason. Because if there is more reason, let me know. And if government is a hindrance, I'll work to remove it. But come on, participate in India's growth.
Why do you think it's not happening? This question's been engaging you. We've had multiple conversations last several years.
This question is engaging me is a wrong thing to say. It's not a question for me in the first place.
Why is manufacturing and capex
there we go.
not...
He asked the question to me.
Yes.
Ask it to the industry. That is a question for them.
What do you find
All
out?
of us are giving our observations about it. It's for industry now to say, no, sorry, we cannot do it because A, B, C of the policy is hitting me. I'll work to remove it. But tell me what's the reason?
What's your theory of what?
I have no speculations to offer.
That's
a luxury media can engage in.
But they don't invest in the same way.
It's your luxury to speculate. I have no reasons to speculate.
Interesting. Okay, but she sent a very strong message, so I hope everyone's listening. I'm going to get Neeraj Shah to ask a question. Neeraj, go for it.
Ma'am, good evening. One of the things that the markets has lauded in the budget is this tax holiday for data centers. I was wondering if there is a thought of, if this attempt succeeds, to have more sectors in order to attract FDI, or is this a one-off because it's got some AI connection?
Well, nothing is one-off. They're all part and parcel of a larger scheme of making India more investor-friendly, making India more manufacturer-friendly, and so on. So we'll keep doing this.
But this was a landmark, sorry, which is what I was asking. 22 years is a landmark.
You wanted big-ticket announcements. You wanted things to be done in a big way.
What are your calculations on the impact of this announcement on the tax holiday for cloud services and data centers as a spur for future investment over and beyond what's on the horizon at this moment? How many more data center projects do you think can potentially come to India? And the fact that data centers are huge energy guzzlers and therefore it requires a massive spur in investment on energy production, which is something which is one part of this data center equation which doesn't seem to have been addressed, at least from what we can see in the public.
Since the last budget, we've been talking about the small modular reactors. The Parliament is passing bills which are necessary for establishing nuclear energy in India. The push for renewables still continue. We have also given a lot of announcements about pumped storage, which is also green. And therefore, the emphasis on making India energy self-sufficient is in place, and we are doing everything it takes to make sure that we are able to produce more.
No, so to what extent can it be a spur for?
I won't.
You must have done some calculations. You have done some modeling before you make that announcement. What does that modeling look like?
It looks very good. I propose to raise the STT on futures to 0.05% from the present 0.02%.
There's a buzz of a potential hike that could happen when it comes to options STT, and this could be major negative coming in.
Presenting the all-knowing, all-powerful Tech Guru.
Whoa. Guru? I'm no guru.
Okay.
I'm just a guy who loves his tech.
A show where the mysteries of megabytes and motherboards shall be unraveled.
Bro, nobody talks like that anymore. This is all about connected ecosystems, EVs and AI that you can use in your daily life. That's what we do on Tech 360. Real talk, real reviews, tech that you can actually use.
Tech has changed. So should your tech show.
Alright team, our new order show is ready. Now we need a promo. Something cool, something sharp.
Well, I'm sure we'll be having outstanding reviews, solid suggestions,
Expert advice, the latest trends. It's a lot simpler. We'll help people make the right auto decisions. It's got the cool stuff, geeky stuff, serious stuff, all of it, so that you can discover, decide and drive. I'm Siddharth Sharma and I am your automate.
New year. New power panel. India market open. Now in its boldest lineup. This is where the trends get tested and stocks get conviction.
I'll recommend a buy call on a stock.
Good evening, I'm Vikram Oza, and tonight on The Big Question, we're asking something that India has debated for decades now, but never with this kind of urgency. So now India is the world's fastest growing major energy market. Our demand for oil and gas will keep rising for at least the next 20 years. And yet, we import close to 90% of what we actually consume. So every geopolitical shock, from the Middle East to Russia, Ukraine, all of the geopolitical shocks reminds us how exposed makes us in India. One tanker route blocked, one sanction tightened, our trade build literally balloons. Across the world, nations are choosing sides. The United States, under the Republicans, has done it years ago with drill, baby, drill. They've opened up exploration, they've backed entrepreneurs, they're turning an energy importer into a producer. China is locking up minerals and rare earths. Europe is scrambling for supply security. So everyone is digging in. Where does that leave India? This debate has resurfaced sharply after the comments that we've got at the NDTV conclave, and also today, this social media post on X, which you're looking at, this coming in from Vedanta chairman Anil Agarwal. He argues in this post on X that India has the resources, it has the talent, it has the cost advantage. But he says India is being held back by fear, regulation and policy uncertainty. So his message is pretty blunt in this post he's put out, that the world wants India to be a market and not a producer when it comes to energy. But critics are pushing back. They warn of the climate risks, they're talking about stranded assets, and they're questioning whether doubling down on hydrocarbons makes sense in a world that is racing towards energy transition. Which is why tonight it makes sense to ask this question. The big question tonight is whether this paradox is going to be resolved or not at this particular juncture that India finds itself in. Viksit Bharat, yes, but when it comes to energy security, are we going to drill at home or are we going to keep importing as we have? Because that too lends us in different kinds of problems. So what is the future looking like? Where the importance of hydrocarbons is falling. We're talking about energy transition. So is this going to be a costly distraction for us? Or do we need to double down on our Atmanirbharta when it comes to energy security? That's the debate that we're going to have. Let's take it across to the panel. Let me introduce you to them. Well, tonight on the show, I have Prasenjit Pal joining us. He's independent consultant and former executive director at NTPC. Sukrit Vijayakar is also with us. He's global crude expert and founder of Trifecta Consultants. Great to have you, sir. Pratyush Sinha, Senior Vice President at Loham, also with us. Great that you could join us today. Prasenjit Pal, in one line, if we can just set the tone of this debate. Short answer, should India aggressively drill domestically, or is the heavy dependence on imports going to be a simple reality?
Okay, India, as I always say, has to go for a basket approach, and therefore there's going to be local drilling as well as the international approach.
Sukrit Vijayakar, from a crude market perspective, is India better off chasing some level of self-sufficiency or shopping the world for the cheapest barrel? Is that going to be our story?
Well, India has always been chasing locally for production, and they've been doing it right from 1977, from the days of Bombay High. They haven't found it. They've gone to Rajasthan, they've gone into Gujarat, they found some gas reserves which were hopelessly overstated. The fact is that we haven't found oil. Yes, we will continue searching for oil. But right now, we have, if we do not utilize our capacity, we will have to import diesel and gasoline, and that will make us far more dependent on the world than just importing crude oil itself.
Pratyush Sinha, from an industry and technology standpoint, does this make sense for India right now to expand oil and gas exploration today, like Vedanta chairman Anil Agarwal is suggesting in his post? Pratyush, you've muted yourself.
Yeah.
Yes,
Sorry.
Go ahead.
Yeah, I'll come more from a rare earths and critical minerals point of view.
Sure.
Because when we talk about energy security, a lot of it has to do with the fact that a lot of our additional energy capacity that we are building in is coming from renewables and from new age sources of energy.
Yes.
So, to secure that supply, again, we are dependent a lot on imports even there. Long term, what a goal should be to have as much domestic value addition as possible over there, because to keep in control our import bills. We do have a lot of raw materials when it comes to rare earths, if not for other minerals. Short to medium term, the goal should be to ensure that domestically we are collecting all the scrap and recycling, especially for metals, and we are acquiring captive assets globally.
Right.
So that we can get the material at a cost plus basis instead of buying off the market. Long term, the goal should be to explore and find assets in India and ensure that a large percentage of our demand is domestically met.
So if the future is about rare earths, it's about the magnets, then does it make sense to double down on hydrocarbons? Would that be a smart move, or is that a step backward? Prasenjit Pal, what do you say? Because I'm looking at domestic production of oil, which has fallen from 36 MMT in 2014-15 to 26 MMT now. So why has not India been able to increase output despite all the policy tweaks we've been doing?
Actually, I'll have to answer this in two parts. One part is there is this overwhelming thought about reducing the carbon footprint. So given a choice, everybody would like to go fully electric tomorrow. But is that possible? It is obviously not. The mobility industry is moving towards electric, but there are steps to go through. Now, in terms of oil, primarily we become dependent on oil for many of the processes and many of the kind of transportation and other industrial requirements. We've been trying to increase our oil production, yes, but there obviously are certain limitation in terms of the amount of oil available and the kind of fields that we are able to find and exploit. So the domestic production has increased a little, but it has not really gone up the way we would have liked it to go up. So again, we are dependent for energy primarily on two prongs. One is electricity and other is the oil. On the electricity front, there has been a movement. We are now trying to move away from coal-based and other hydrocarbon-based into something like nuclear and all. But yes, it will still take time. So we are in a transition phase. And while this transition goes through, in a part, we would still have to depend on both coal and oil for a substantial portion of maybe the next 20 years.
If we have to keep relying on coal and oil, at least for the next 20 years, Sukrit Vijayakar, now that India has been buying nearly 40% of crude from Russia at around $69 a barrel, it's cheaper than most suppliers. But given that, is domestic drilling even cost competitive when you're talking about that? Because even that is now being brought to question because of our trade deal with the US. But even considering that we sustain this kind of price for crude, is that going to be a competitive cost option for us to do more of domestic drilling?
Well, domestic drilling has to go on regularly. Once you find the well, you can decide whether to produce from a well or no. In the US, they have a number of drills that are going on, constantly looking for new sources. The American shale producers control the production that they make out and provide to the market. So while oil markets outside are cheaper, we should be importing. Should oil become more expensive and the cost barriers are overcome, you should be using domestic oil. So the fact that oil is available cheap today is not a reason to stop exploration, in my view.
India is claiming that it has 300 billion barrels equivalent in potential resources. From a technology perspective, from an exploration standpoint, is that something that is realistic or overly optimistic? Pratyush Sinha.
Oil and gas drilling is not my area of expertise, so I won't be able to tell you whether that number is realistic or not. Yeah, but what I can certainly say is we do sit on a lot of reserves of a lot of different kinds of minerals, and a lot of exploration has only just begun. If you look at Ministry of Mines and the auctions that they've been doing, so I do hope to see a lot more mineral resources being discovered in India.
So Pratyush, when you make that comparison of where we stand on oil exploration with what we are trying to do with rare earths right now, because there's a lot of catching up to do, a lot has to be done right here, right now. For oil exploration, we are far behind. But when it comes to rare earths, that's a place where we find ourselves equally lacking, because the way China has been at it and weaponizing this entire rare earths bit, how much of India, the position that we are at, how much further do you think we have to go to be able to get self-sufficiently, even if you are looking at 20 years down the line?
So, see, when it comes to rare earths, I think there is a misconception that these minerals are rare or not found in India. India has one of the largest reserves of rare earths in the world. And India has been mining these rare earths for the last 70 odd years. So we do have a lot of these minerals. What we don't have are some specific categories of rare earths, which are only found in China, Myanmar, Laos, and some of these countries. And what we don't have is downstream processing capacity. And that is what is coming up now. Typically, a downstream processing capacity will take less time to come online than a mine getting fully operational. So with rare earths, at least, if we play our cards right, there is an opportunity to get to a stage where there is sufficient self-sufficiency. For other critical minerals, we will probably need to do more exploration. And as I mentioned, in the short term, it might be better to, it might be a good idea to look at assets that are closer to production and go and have captive acquisition of them so that we can access those materials.
Right. So it's very important to get those captive material and to ensure that for the future as well, if we get our processing bits right, then the catch-up becomes that much easier. Of course, we are still far behind on the processing of it, as I understand it from earlier discussions over here on the big question as well. But Sukrit, you were making a point.
Yeah. Historically, all claims about reserves have always been overstated. In the early 2000s, Reliance claimed to have found a massive gas reserve of around 22 trillion cubic feet of gas in the KG22 basin. That got muted down to 15, and then eventually what happened, I don't remember. But these are typical overstatements. It's very difficult for anybody to prove that I have the reserves I say I have, but you will have reserves, even if it is 70%, 80%. Like 2/3 of your figure is a bit of an overstatement, but part of it could be mistake, part of it could be, hyperbole.
Right,
for want of a better word.
Yes, so this kind of data is something that we'll look at credible sources to be able to get. At the end of the day, we can only rely on what we have by way of numbers. But at the end of the day, we're still talking about creating self-sufficiency. And Pratyush Sinha, India claims that it has 300 million barrels equivalent in potential resources. That's that one figure that we have. But now Anil Agarwal is saying that India has just 200 active exploration licenses, when it should actually have 2,000. So is the real bottleneck policy? Is it bureaucracy? Is it fear of investors as well? Which one is true over here? If we have, by way of licenses for active exploration, only 200, why is it so few?
No, that's a good question. So I'll just take an example of what the Ministry of Mines has been trying to do along with the Ministry of Coal. The number of till around 2 years ago or 2.5 years ago, we barely had any exploration going on when you looked at a lot of these minerals. And in the last year, there have been auctions of over 50 blocks. The number might be closer to 100 now. And a lot of them have received a lot of enthusiasm. I wouldn't say every asset has been mobbed up, but there's been a lot of enthusiasm over there. So it's something that the government is still figuring out, iterating on the right model that will attract investors. But I think that step has already been taken. What we do need is maybe some exploration technologies, because exploration again is something that India has not done historically very well. So probably we might want to work with, say, the Australians or the Canadians, or I don't know, a lot of these companies which have a lot of mining expertise, and bring in technology from there, invest in R&D and exploration in India. And ensure that we hit typically what you want is a good hit rate.
Correct.
So introducing that hit rate, and in a lot of cases, making a lot of the data available democratically so that more minds can work on that data, because you have all these different kinds of tools available now, but the data is often not available. And again, that's something that the government has started to do. But I think we'll start to see results over time.
Mr. Pal, what do you think? Where the potential lies and where we are at when it comes to exploration, and from your own perspective, India is constantly, by way of the pricing, if you consider taxation, the contract regime, does it make long-term exploration attractive or unattractive for private players, for that kind of investments to come in to drive this?
Actually, you see, what is very important is most of the mines which were easily accessible, whether it is an oil well or a coal mine or any kind of mine for that matter, has already been exploited. What remains now are mines in rather remote areas. So obviously, matter of accessibility, the cost involved in exploring that mine and the cost involved in exploiting that resource is going to be fundamental to business, because no private sector, or for that matter government sector or any sector, would like to go in for a business that would be, right from day one, a loss-making proposition. So therefore, the location of the mines and the availability of the resources is very important. As for the taxation and other things are concerned, the policies are enabling.
Okay.
But the problem is the business needs to come forward and do it. And while cheaper sources may be available across the world, it wouldn't normally make a common business sense to sort of go into a high cost exploration area. But then, talking in terms of long-term energy security for the country, long-term mineral security for the country, I think we have to explore these resources and keep them ready so that as and when the international price jumps, as was being made out, we should be able to switch over to domestic. So that is the kind of preparation that we need to take.
But it's not just about the price jumps. You're talking about geopolitical instability as well, which is what the finance minister in the conclave that we had in Delhi over the weekend as well is constantly highlighting, that domestic factors are looking very strong. But she is very concerned about any kind of shocks, which would be global in nature and external in nature. We are also joined by Ajay Shankar, Distinguished Fellow from TERI, the Energy and Resource Institute. Great to have you with us, Mr. Shankar. Glad you could make the time. But tell us, because globally investment is moving towards renewables. So then the question is also whether we are risking stranded assets by pushing exploration. Even if we were to do it, even if we want to cover ourselves for the next 20 years, would we be compromising on what we really require beyond the 20 years when the world is actually trying to pivot away from fossil fuels?
I think you have raised a very pertinent issue, because we need to take a long-term view and undertake a net present value calculation, assuming that we will reach net zero by 2070. So if we are going to be net zero by 2070, if transport will move into electricity at the rate at which it is going, and if the hydrogen economy succeeds, then we need to do a very careful calculation of what our projected demand would be and what the demand would be depending on the prices of the alternatives. So if you look at the situation right now, for two-wheelers, three-wheelers, four-wheelers, and even buses, electric mobility is a better option. If you look at the railways, they've done 100% electrification. So we need a very careful consideration of the long-term net present value costs before we jump into very expensive, lumpy capital investments or long-term contracts. This is the first principle. Going further, I would say that in terms of energy security, we need to look at it holistically.
Right.
So if we are importing solar panels from China, we are as vulnerable as we are for oil imports. If we are importing batteries from China, we are as vulnerable. And China has shown the rest of the world in terms of its eyeball-to-eyeball confrontation with the US,
yes,
that it has leverage. So the lesson for us is to, how do we take a medium to long-term strategic view and become self-reliant in the new technologies?
But self-sufficiency, by its very definition, would perhaps be something that you plan for the future, right? And if it is the future, there is the 20-year horizon, and then there is the period beyond that. So how do you strategically do that, keeping both interests in mind, because it's so dynamic?
May I just come in that
certainly
earlier thought that you need 20% is dated. So I'll give you an example of solar panels. 2005, the Germans were the leaders in manufacturing and in technology. By 2015, the Chinese had destroyed the German industry. So what China could do in 10 years, why can't we do in 5 or 7 years if we get the ambition and our act together?
Fair point. Fair point. Prasenjit Pal, you want to take that point that is being made over here? Because it is doable that you can have both sides considered and a strategy that is laid out that would work for the period that we are talking about, where fossil fuels will still be required and we need that kind of security, and the period where we are going to move towards renewables much more away from fossil fuels.
No, absolutely right. What we need to do, as I said right at the beginning, coming back to what I said, that we have to have a basket kind of an approach. So if we are going to depend more on renewables, then we must have some sort of additional or dependable storage solutions. And now these dependable storage solutions need not necessarily be batteries. They could be pumped hydro, they could be any other type. In fact, we could even, dovetail the hydrogen economy to the energy sector in such a way that we do demand side management by generating hydrogen when there's power supply in excess because of excess renewables, and therefore try to manage the grid in that way. So it would be a very good option if we could perhaps use hydrogen production as a demand side management tool to manage the grid, in addition to the storage facilities, so that we are able to better incorporate the renewable energy that is abundant at certain hours of the day.
Right. So this diversification is very important from every perspective, whether it's the basket of energy resources that we are talking about, or even oil right now. Russia, Iran in the past, US, Saudi, all of them offer India more energy security when you diversify to that extent than solely relying on domestic drilling as well, which we are far from in any case. But this entire concept of diversification, where are we on that count? Sukrit Vijayakar.
We have got good ties with Iran, with Russia, with the US, etc. Before I take this on further, I'd like to comment on the licenses issue. You see, bidding for licenses is like pricing of an IPO. You can price an IPO like Paytm, which kind of sank without a trace, or you could have an IPO which is something like a lottery, which is what makes people cagey about bidding for that. You could probably have a revenue sharing kind of model, which would probably make it easier both on the government as well as on the bidder. Coming back to diversification, we are fairly diverse. Yes, we tend to prefer to procure from the Arab Gulf, but that is because the travel time is much less, which makes your working capital cycle lower. Recently, there was an item in the news about Venezuelan oil replacing Iran. That is kind of hype. Venezuelan oil is of just one type, whereas Iranian oil is spreads across the spectrum.
Correct.
So the kind of oil Venezuela can provide is not the kind of oil that all Indian refineries can use to the tune of 100%.
Right. So if I have to wrap up this discussion, and which I need to do, but Prasenjit Pal, if India had to choose only one, energy independence or lowest cost energy, what should be the national priority? Short answers, if I may.
The national priority should obviously be energy independence, but then economy is going to play a very big role, and therefore it has to be energy security at the most economic possible basket solution.
Sukrit Vijayakar, at this point, is the push for more domestic drilling, you think, a strategic necessity, or has it become an emotional argument rather than an economic one?
It has become more of an emotional argument rather than an economic one. As I said, it is good to keep on doing it in the hope or really lottery lag jaya kind of thing, and we find some oil. But till then, all this refining capacity was built not with just a view to provide the domestic market, but also to export. India is a net exporter of products, which it wasn't at the start of this century. But with what Reliance did, what SR and then Naira did, what the public sector has done with new refineries coming over the past 10, 15 years, it has made India self-sufficient in products. And to say that I will not buy crude, and let my refineries starve because I want to be energy independent does not make economic sense to me.
Pratyush Sinha, where do you stand on this entire argument of what we need to plan for the future in terms of where your interests lie as well when it comes to rare earths and magnets, as opposed to any kind of expansion in hydrocarbon exploration? Where do you think the focus needs to be right now towards greater security or perhaps managing our risks, whether they are now or in the future?
Sure. So, see, we know that the world is moving towards a certain kind of energy mix in the future, and we need to plan for that. We need to ensure that in that world, we don't suffer from the same kind of dependencies that we have had for the last few decades. We need to do that at a mission scale. And what that requires is a few things. One, we need to ensure that we're focusing on the entire value chain end to end. It shouldn't happen that we just do one part of the value chain and are then dependent on other parts of the value chain on other countries, whether that's China or Korea or even other allied countries. The second is we need to ensure that basically we have captive access to material. And that's the most important thing, because you cannot compete with China. You cannot compete with predatory pricing that comes from China if you're dependent on the open market long term. You need to ensure that a certain large percentage of your overall demand is met through captive sources, where the price is the price of taking the material out of the ground or taking the material, just collecting the material from scrap.
Right.
So when we can ensure these two things, the entire value chain, focus on the entire value chain and ensuring that we can get the feedstock at low cost, I think that the transition that we are talking about over 20 years or whatever period can be hastened a lot.
Right. So the point is this, that India needs affordable energy today and we need clean energy as well tomorrow. And the real challenge is balancing both without compromising our security, compromising our economy, or indeed our climate. So whether drilling more is the answer or smarter diversification is the way forward, like we discussed, at least one thing turns out to be clear, that India cannot afford to get its energy strategy wrong at this time. It's a crucial juncture where we are at, looking at all the geopolitical risks that have been stated and restated. Thank you to my guests for joining us with your sharp insights. Prasenjit Pal, Sukrit Vijayakar, Pratyush Sinha and Ajay Shankar. Thank you indeed for sharing your views with us on the big question. Indeed, the question has been raised because of that post on X by Vedanta chairman Anil Agarwal, whether India needs to pursue more oil exploration, whether we can, whether we have the resources, and whether or not we should, even as the world is moving towards the renewables. If that is going to be our call right now, to be able to get our energy security perspective right, it's going to be an important question to answer, and we'll keep raising it until we do find the answers. I'm Vikram Oza, from me and everyone here on The Big Question. Good evening.
Ladies and gentlemen, at the NDTV Profit Conclave 2026,
this will be a $30 trillion economy in 2047.
At this moment, as Finance Minister, what's keeping you up at night?
The uncertainties from outside are still where they were.
Can we see this deal through?
We are amongst the first to start negotiating. So our deal is very holistic, comprehensive.
The reason why we wanted to bring in this little increase was more for deterrent purposes rather than for revenue purposes. I propose to raise the STT on futures to 0.05% from the present 0.02%.
There's a buzz of a potential hike that could happen.
There is rarely a time in financial news coverage that things move so fast that the whole perspective of your conversation changes. And I was just thinking about it. We had an extensive, detailed and exciting economic survey. Then we had a promise-filled budget with some really new, innovative ideas. Then you had a monetary policy which added dimension. And here comes the India-US trade deal announcement to framework in 4 days flat. I wonder, we journalists are gasping for breath. As the chief economic advisor, how busy are your days right now? Let me start with that question.
If you guys have been sort of gasping for breath, you can imagine how it is inside. Over the last 6 to 8 months, as the PM has been saying, the Reform Express has been underway. So apart from these 4 things which you mentioned, and also you missed out the Indo-US free trade agreement that happened.
The EU. The EU-Indo free trade agreement.
So that also happened in the last 2-3 weeks. And then, in general, I suppose, along with the overall geopolitical developments in other areas as well. So it's been quite an intense 1 year, I must say. And but we are happy that both these 2 trade agreements do set up the economy nicely for 26-27.
I think it's the reform bullet train, not just the reform express right now.
That's well put. Yeah.
Let me come to brass tacks though. Let's start talking about the GDP number. We have a range in the economic survey, 6.8 to 7.2%. This was, like I said, this is a week which seems has 3 months or 6 months of news flow in it. From then, taking into consideration the India-EU FTA, the India-US interim agreement ahead of the bilateral trade agreement that comes in, is there a good case to revise this upwards? A lot of headwinds which would have been baked into that range have now receded, and visibly.
No, I agree with you. So that's why I said in the couple of days since the US-India agreement came into the picture, I did say that there is an upside risk to my range of 6.8 to 7.2, or let's say the midpoint is 7. Now I can think of an upside that could last anywhere between 20 to 40 basis points. But the reason why I would still wait until we see at least the first quarter of data for the new financial year. First, we have to wait for how the GDP numbers, new revised series, and the new base year play out. And secondly, simultaneously, if you read the economic survey preface, we talk about the 3 global risk scenarios, and they're also beginning to play out simultaneously. The way the volatility in financial markets has been rising in multiple asset classes, etc. Those spillover effects are still probably underway, etc. So there are, while India-specific developments have been positive unambiguously, we need to also factor in these global risk factors. And if we do that, then I think we need to take a calibrated look at how far I can increase my growth projections, or am I comfortable with the range that I have already indicated, is something that we are still working our way through that.
No, fair enough, but all things remaining the same. Between the economic survey in the last day of January and now, the volatility in commodity prices, say, remains the same. Other global risk factors remain the same. Maybe AI comes in as another risk factor, I don't know. But one major, very visible, glaring problem seems to have receded. Is it fair to say that 7.4% is not an out of the park kind of an upper end now that we can look at?
Before I answer your question, I must say I'm very impressed with the way you said everything else remaining the same. I thought only we economists keep using ceteris paribus, etc. This is the first time I'm hearing a journalist using those expressions. Ceteris paribus, of course, you said other things remaining the same. So I'm quite...
so we're listening and learning.
So, look, again, but unfortunately, we know that other things are not remaining the same, right? Gold went from 4,000 to 5,300 and came back to 4,600, now again back to 5,000. And what we are seeing in copper, etc., or for that matter, our own bond yields now close to 6.75, 10-year bond yields. All these factors are also happening simultaneously. Yes, I have to put on the positive side of the ledger the US-India free trade agreement, which wasn't expected in general, and our own projections of 6.8 to 7.2 did assume that status quo would continue and not an announcement would happen. And therefore, on that score, you're absolutely right. But I also need to understand that, as I said, other things are playing out as well. But on balance, I would still say that now I'm prepared to concede that there is an upside risk to my growth estimate rather than a downside risk. So it's skewed towards the right side rather than the left side of the tail.
Mr. Nageshwaran, on the trade deal itself, we have seen, the initial agreement talking about, stopping oil from Russia. That's one of the conditions. Just wanted to understand that whether it will have an impact overall, not just diplomatically, but also financially. Are you reading that India may face potential loss as a result?
Look, I think these are relatively sensitive, and I don't think there is much to be gained by speculating on these things in public. Okay? At the same time, I can say that oil prices will be subject to, again, using Tamanna's phrasing, other things being equal, if the Iran situation doesn't get out of control in the Middle East and oil prices remain the same. So from an oil procurement perspective, it may not necessarily mean a big deal of difference to India. And also Russia is aware of the fact that after the Rosneft and Lukoil sanctions were announced, there was a natural tendency for India to remain cautious because we didn't want to expose our financial system to sanctions as well. So they also understand the compulsions, just as many other countries also take measures to safeguard their domestic industry in the face of sanctions. I mean, so when Nayara Energy got shut out, when Microsoft Office, removed their email client server facilities, even Zoho couldn't offer them an alternative because they were serving European customers as well. So they didn't want to get caught in that sanctions web. So there are compulsions and countries understand that. So I don't think this will be a major problem area for us.
Just also wanted to understand that India and US has trade surplus with 18% now we agreed upon. Do you see that thing continuing? We will remain trade surplus with 18%?
No, I don't think obviously you should look at India's duties alone in isolation. It has to be seen in the light of what are the duties that other countries face. And if you read the statement this morning, you would have also noticed that there is a line about that says India will continue to negotiate for lower duties from the 18% level. So 18% in isolation might appear as if it is higher than what it was 1.5 years ago or whatever, or 1 year ago. But obviously other countries also in the region, your competing countries face a similar or even slightly higher duty. So in that sense, I think it will continue to serve as well.
I just have a couple of follow-ups, and I'm going to rephrase Shrimi's question and ask it again because I think it's an important one. And I understand that we're waiting to hear official word on how much India reduces Russian oil, do we shut the tap, etc. My question is, can we afford to? Does the math work?